All right, friends. Sumit this side. Can you just confirm anyone am I audible to you guys or not?
Yes, Sumit.
Yes, Sumit, you're audible.
Yes,
Yes,
Sumit.
All
you're
right,
audible.
great. So today it seems to be only limited people. 30 people have joined so far, and still 14 to 15 more people could join. But we can start. They would join. So yeah. So we were in the fixed income securities, right? And we had understand some of the topics in fixed income securities. So just a quick recap on the broader perspective that what all we had touched upon as a part of our earlier session. We tried to understand what a debt instrument is, right? We understand some of the very important features of debt instrument is like fixed flow of income, coupon rate, frequency with which coupon will be paid by the issuer to the investor. The return comes in two forms. One is the coupon receipt, and the second is capital appreciation. We understood the concept of redeemable. We understood the concept of redeemable. We understood the concept of issuing the securities in the form of who can be issuers and who can be investors, and yeah, in the form of public issuance or private placement. And we understood that most of the, that is more than 90% of the issue happens in private placement manner, and also in the secondary market, 90% of the securities gets traded over the counter and not on exchanges. But if it is listed, it can be traded on exchange also. But most of that traded is in OTC market. That also we had understood. And then we had understood the issuance can happen at premium, at par, and discount. And the redemption can happen at premium, at par, and discount. And accordingly, what could be the face value and what could be the issue price. And accordingly, we understood that what investor would end up paying and what investor would end up receiving. Those are the things, and we understood the difference between par value and issue price. And then there's no it's not mandatory that those two values will be same. Because it can, if the issue is at par, then the par value and the face value, the issue price will be same. But if issue is at premium or discount, the issue price will be different from the face value. And then we understood the concept of dealer or market creator or investment banker playing the role of helping the company in issuing these securities to institutional investors and charging a fee of it, right? Then we understood the frequency of coupon payment and how this would impact and how you would calculate the interest based on the frequency of coupon payment. We understood the concept of credit rating and why it is important and what kind of various different kind of ratings offered or assigned to issuance and the company, and who are the global and pioneers and domestic companies who are respectable credit rating companies in our country. So we had touched upon those aspects, and then we had touched upon a very important aspect of yield and current yield. And we saw that, and I told you that generally these days yield is replaced by something called as return on investment, and current yield itself is called as yield in today's parlance, and how the market price decide the yield, right? So that is something we had touched upon so far, right? So and then we had seen a couple of examples for these, and and all. So any questions on the concept we had touched upon so far before we move forward? Anyone? Come on. The floor is open. There are 33 people, excluding me. So yes, just think, just ask a questions if any.
Hi, good evening,
Yes,
sir.
Dhruv. Good evening, Dhruv.
Just one question regarding DRs, depository receipt. Do DRs carry any validity, expiry date or something?
See, like, the validity, it is like equity, right? So equity as such do not have a redemption date, right?
Okay.
So it's as good as equity. The only thing is, Dhruv, why,
Yes.
you can ask this question, that why a company is not directly issuing shares like it is issuing shares in its domestic country, right? Why it has to go through the route of DR, right? This is one question which can trouble you, and I understand. But this is what trust issue through. So, for example, even let's talk about let's forget about equity and everything, Anna. Let's talk about, for example, you planning to export something to someone in US. Simple setup, right? Very basic core thing, right?
Yes.
It can happen now that you are a business person, you want to export, for example, tea powder to someone sitting in US for $1,000 per kg. Now you would say, "Nee, it's expensive. Why? Nobody will buy it." But there are people who are actually doing it through. And I would take you through that example later. But yes, I will show you that this person who is selling tea even to that premium price on the name of green tea and all, on the organic tea and also that's different. But for example, you want to get into that setup. Okay. Now, you know the problem, Dhruv, is one transportation. It is not like an email that you send right now and the other person receives right? So you deliver the tea from here, the fastest route maybe by air, right? It reaches to the person. So it can do, for example, my CFA, I didn't have any personal experience other than a CFA degree. Okay. So when the CFA Institute US had to send me a CFA charter to me through air, right? I received it after 20 days. So obviously they would not have sent in a fast courier manner. Maybe I guess in today there are opportunities where things can be sent even earlier than that, right? So still in that case, from point A to point B, you can send something from India to US, for example,
Hello.
a particular place in US. Yes, Santosh?
Sumit, I'm so sorry to disturb. Actually, there is a lot of disturbance around you. We are not able to hear
Yeah,
you
not
actually.
so it is from Dhruv's side. Actually,
Yeah,
Dhruv, wherever Dhruv is sitting, there was he is not gone. Now there is no disturbance which is right.
exactly. Thank you, Sumit. Thank you.
Yes, Santosh. I was telling you now, Dhruv, you can unmute whenever you want to come again and ask, right? But I will just give this understanding to you. So it takes some time, and during this time, there is a problem because money can be transferred immediately. You can send money immediately through wired networks, right? Through internet and through wired networks and all. But the problem is transfer of goods. There's a trust issue. You would say, I would transfer the goods once I receive the money because you're an exporter. The importer who's sitting in US has a trust issue with respect to that I would transfer the money once I receive goods. Now, through a trade can never happen because of this trust issue. And banking channel group plays a very important role in this export trade. Because banks comes into picture and they remove this trust issue by a product called letter of credit. Letter of credit. The name itself must give you an idea that what it's about. So it's about, for example, if Dhruv is going to join a job, but the person is not trusting him, Dhruv comes to Sumit Rathi, say, can you issue me a letter which I can show to the other party? And because you have some reputation in the market, the other party would trust me. So I give a letter to other party. Hey, XYZ company, Dhruv Sardana is one of the best candidate you would get in your life. I have had interaction with Dhruv many times and I have had a very good learning relationship with him. So you can trust me on this that Dhruv is the best candidate for your company. And then letter of credit. With that letter of credit, the company accepts you wholeheartedly. So this is the role which a mediator can play in arising the trust back between two parties who are geographically so diverse that it is difficult to trust them. It is difficult to research on them. So it is a very normal thing. So that is why as a company, so same thing is there. You see, there is the mediators in the issuance of securities, the deposit receipt. Again, the trust issue is there. A issuer wants to issue the capital, issue the shares by raise the capital from international market, right? Investors want to invest. ऐसा नहीं है investor do not want to invest. For example, if you get an opportunity to directly invest into companies like Microsoft and Amazon, would you not like to invest in them? Maybe 5 years back, today maybe they are, well, forgetting about the on the valuation aspect. You can say the valuation is very expensive, Sumit. So at current price, I would not like to buy it. Maybe wait, let's leave that aside. Otherwise, from the perspective of quality of companies, would you not like to be associated with them? आपको job मिल जाए. For example, you get a job from Facebook, Meta. Would you not like to accept it? Tell me. People die to work with Alphabet, Google. Yes or no?
Yes, yes, exactly.
And everybody would like to be associated with company like Google or this. So as a need, but the problem is trust. Google and all, maybe these are 4-5 names from that geography that has great brand value. But similarly, there are great companies in US which investors would like to invest into. Similarly, there are some companies in India where US investors would like to also invest into seeing their trajectory. But the problem is trust issue. And this whole long story ends over here that to remove this trust issue through, there are parties involved. Investors say we are ready to invest in you if you bring depository receipt in. So if you bring depositories in picture. Why? Because we trust our country's depositories more than we trust your company. So if your company directly want to raise capital, we might not like to buy or invest in your company. But if you come through the route of my country's depository, that is DTCC, which I have grown up seeing, right? Since my childhood, I know the company and everything about that company because it is on my soil. It is on my land. I trust it. If you come through that route, I am ready to give you capital, money, because that is all you want to raise, right? When you want to issue capital securities. Here, you say, okay, I come through the route of DTCC, but DTCC say, boss, why do I trust you? You can be XYZ company of your country and you can have this and that and that. You can have all the luxuries of the world. You can have all the brand value in place in your domestic country. But why do I trust you? Yeah. Still, if you are interested in to do business with me, why not you bring a custodian bank, which also has a brand in my country, which is present in your country, but also has equivalent or even better brand in recognition in my country. So then you say, okay, I bring Citibank as my custodian bank. DTCC, okay, I trust Citibank. So if you are going to ready to put your shares to Citibank and Citibank is ready to confirm that, yes, it would keep the custody on my behalf, then I am ready to issue the share depository receipt, which is nothing but shares to my investors of my country. And I will pass on that money to you. So this is whole, the only reason is of trust. Rest, everything else remains same, my dear friend. If there is no trust gap, group, then there is no need of depository receipt. If there is no trust gap, there is no need of depository receipt. As simple as. Yeah, there are 10 different other things कि forex का भी scene है, ये भी है, उसका currency different है, उसके लिए भी चाहिए. मतलब if you will go and read on theory, you will get 10 more reasons. But this is what the landmark reason is. Rest all is, stories built around here.
Understood.
Right. So I know you asked a very simple question and I could have answered it by saying yes or no. But I thought, because you have this query, so why not I just give a little more color to it. Maybe it add to your understanding of the product. Cool. Okay, any more question, guys, on the topics we discussed or till today, till yesterday, basically, till the last day, any topic. It is not only with respect to fixed income, anything, cash equities, introduction to FS, anything regarding that, you can ask.
Hi, Sumit.
Yeah.
Sumit, we have completed cash equities, but in the LMS part, there are many topics which are left, such as IPO process, lead manager, share capital. What about those topics?
So Mayank, obviously on your LMS portal, there would be content which would be much more than what we are discussing in a closed classes, right? So if you remember my first session, you were there.
Yes,
that you should go through all the presentation, your reading, your study is not only about these classes, but your study is about going through all the things, including LMS portal, training material, reference material, whatever there is on your LMS portal, all the quizzes, assignments, you know, and in addition to that, you have this online instructor led session which you have with me, right? So yeah, you can go through that. Things are very clearly explained over there, much beyond what we are discussing, I'm sure, because if books are given, books are can be of 1,000 pages, and what we are doing, if you put it into book Excel, we are just filling what 10 pages at max, right? That is what the limitation of class. But you can ask me if you have gone through that, because you are expected to go through that before coming to the session, right? That is a promise I have taken you the day when we started the session, right? That before coming to any topic, you would go through the sessions, which are things which are there on your LMS portal. That's like what is expected. Now, if you have questions on that aspects, you can ask me. I would be more than happy to explain that. Maya, can you hear me?
Yes.
So you go through the content. There is a lot of content there. We are touching about the most important aspects of it, which is you must know. But yes, if you want to know beyond that, you can go through that, and you should go through that. You must go through that. And if you ask questions, it will add more clarity to you. अच्छा, तो कोई ऐसा topic है which you thought कि I didn't understand, which is explained over there? Because as such, we would have touched, for example, lead manager. If you remember, we had touched upon lead manager, that an investment bank is a guys. Do you remember what is lead manager? Anyone?
Yes, lead managers like investment banks work as a lead manager. They are the ones which finalize everything, as rating of IPO, how much IPO should be rated, at what interest rate. At the same time, they can also connect with other investment banks if they want, just in case if the IPO amount or the shares amount or the shares number of shares are of higher quantity.
So those are called co-lead managers, right?
Yeah.
So Mayank, did you understand this? We have touched upon things like that, right? Maybe not in the fashion which is there on your LMS portal, but the sequence might be here and there different, right? So if you have questions through it, I am ready to explain each and every concept which you're not able to understand, which is there on your LMS portal.
I was reading IPO last week. I have just one question. Why the Paytm IPO failed?
Sorry, why?
The Paytm or the LIC IPO failed.
आपका क्वेश्चन थोड़ा क्लियर नहीं है, एक बार वापस से बोल लें क्या है?
Why the Paytm or the LIC IPO failed?
नहीं हुआ, LIC IPO कहाँ फेल हुआ? फेल किसको बोलते हैं पता है आप?
Fail is
IPO फेल
like
मैं एक सेकंड बताता हूँ. मैं एक सेकंड, आप जो बोलते, आप क्यों बोल रहे हो ये फेल हुआ है? क्योंकि लिस्टिंग प्राइस जो है इट इज लोअर देन द इशू प्राइस, राइट? बट दैट डजंट मीन इट्स अ फेल. IPO is a fail, Mayank, when, for example, company wants to issue 100 shares, but people apply only for 20 shares, or maybe there is a minimum subscription which should happen, and every country differs, and the regulator comes up with that. But for example, just to मैं आपको example के लिए बता रहा हूँ, ठीक है? For example, don't think that this is the actual limit, okay? I hope you understand the importance of it, Mayank. And you need to remain unmuted when we are discussing, right? Do not go on mute again and again so that I have to wait for you to unmute. So remain unmuted, please. Mayank.
Yes, sir.
Please remain unmuted. आप फिर वापस म्यूट पे चले गए. आप समझ पा रहे हो मैं आपको क्या बोल रहा हूँ?
Yes.
आप अनम्यूट रहिए. अच्छा, आपका बैकग्राउंड नॉइज होगा, ठीक है? मैं कह रहा हूँ, I am giving you an example, Mayank. Don't think that this is actually the limit. But for example, the limit of minimum subscription is, for example, 80 shares. That minimum people should apply up to 80 shares. Then only you can go ahead with IPO. Otherwise, your IPO will not be subscribed. Means you have to give all the money back. The shares will never be listed. That is called as IPO failure. Do you get him?
Yes, but in that case,
रुको सुनो मेरी बात सुन. मैं आपको टाइम दूंगा आपको सवाल क्लैरिफाई करने का, बट आप अभी मेरी बात समझ पा रहे हो? आर यू एबल टू अंडरस्टैंड व्हाट आई एम सेइंग?
Yes.
right? So IPO is not failed at all. IPO only fails when subscribers do not turn up in the minimum regulatory requirement limit. Okay, then IPO fails, and then those shares never get listed, and the money needs to be paid back to all those subscribers who are subscribed for it. Okay, the shares cannot be issued to anyone. Okay, so that is called as a scenario of IPO fail. Now, what can happen is this: that issue price of an IPO is, for example, 1,000. Okay, issue price is 1,000, but when it get listed, on the stock, it start trading at 500, right? But this is not IPO failure. Okay. Now clarify your question. What was your question?
Yes, I understand that IPO is totally dependent on the subscription. If it's a fully subscribed, then it's not a fail. But just a simple thing, just like Paytm IPO was came with a base price of 2,100.
Issue price, yeah.
Issue price, yes. Okay, and now it's listed for around 700. Yeah, it's now 700.
पता नहीं 1,500 हो गया तो पता नहीं, मतलब मेरे हिसाब से तो वो 0 रुपीस में बिकना चाहिए, बट हो सकता है वो कितने में पता नहीं है. I will just check.
I think it's open on 15 to 1600.
ओपन भी हुआ होगा और ये अभी देखो 700 चल रहा है.
अभी तो
2 दिनों में 0 भी हो सकता है. हाँ बताओ. हाँ.
Simply कि मतलब कि ऐसा क्या हुआ?
Once it get listed, it becomes the price needs to reach to perfection based on the underlying business strength. So if a business doesn't have strength, the market will do justice to it, right? So the population is very large, man. These are some of the IPOs which should have been failed, but still there were enough people who, in the frenzy of IPO, who were ready to subscribe for them, without understanding that not all businesses are HUL, right? So in the frenzy, people just become overexcited and start applying to anything and everything, right? And that is why you see Bitcoin getting traded at so high valuation without having any utility, right? But in the frenzy, even Tesla started making a statement that we will accept Bitcoin. Now what are they doing? Now they have sold all the Bitcoins which they had bought a year back, and now they have stopped taking any payment in terms of Bitcoin. So in frenzy, people can do stupid things, man. So, but then in a long-term period, things get repriced in an equilibrium fashion. Okay. So, have you read this book ever? Well, I'm sure you would not have read this book, but you would have heard the name Wealth of Nation.
Yeah, I heard.
Have you heard the name Newton?
Yes.
Huh?
Yes.
So Newton is from the field of physics, okay, and Wealth of Nation is from the field of Adam Smith had written it, and it is from the field of economics. Those are two different fields, but Mayank, they have a lot of similarities. Have you heard the name Paul Samuelson? A very famous man. If you would try to find it out, you will find that this Paul Samuelson is very famous, who has given the theories with respect to market equilibrium and all, modern theory of portfolio management and all. Okay. Now the point I'm trying to come upon is Newton discovered equilibrium, Mayank. Okay. In the world of physics. In the world of physics, it discovered what? The concept of equilibrium, which Samuelson and Marshall. Were you an economics student ever? 11th, 12th किसमें किया था?
Yes.
Commerce में किया था?
Commerce, yes.
हाँ, so economics करके एक सब्जेक्ट आया होगा, right?
Yes.
Right? उसमें सैमुअल्सन और मार्शल के बारे में बातें हुई होगी, लेकिन आपने बुक्स जो है वो कोई कॉपी यूज करी होगी, मतलब पास होने के लिए, इसलिए आपने ध्यान नहीं दिया होगा. बट मार्शल ने डिमांड एंड सप्लाई का इक्विलिब्रियम सबसे पहले इंट्रोड्यूस किया. किसका? डिमांड एंड सप्लाई विद द कॉम्बिनेशन ऑफ प्राइस. that price will play the role of equalizer. If supply is very low, demand is high, price will go up, right? Everything will be automatically reach to a stage of equilibrium, right? So same, that concept of equilibrium plays in the stock market also in the long term. Short term, there can be inefficiencies, but in long term, things have to be priced to perfection. Are you getting it?
Yes.
Right. So things are getting priced to perfection now. Right. So the real story which the company can deliver you and the expectation with which you have bought, if there is too much of gap, then price will adjust that gap. So for example, you expected the company to perform good. Company performed best. Prices will go up like anything. You expected the company to perform good. Company performed worst. Price will go to floor to zero. Because there are so many degrees in between, right? From best to worst, you have degree of better, good, bad, worse, and then worst, right? So that gap will come down with price being an equalizer, playing the role of equilibrium only. Are you getting what I'm saying? Are you able to understand what I'm saying?
Yes, Sumit.
Yes, yes.
Sir.
Right. So this is whole the game, and that is why things will be priced to perfection. It is like that only. So that is why you should not go mad after every company coming off for IPO and start applying for an IPO thinking कि हर IPO successful होता है और IPO में पैसा बनाएंगे 15,000 का 25,000 कर देंगे 25 का 50 कर देंगे 50 का 1 लाख कर देंगे वो सब जो थियरी है and that is why I am anti traders as such. I'm okay with people trading and all and applying, but I have never put any money ever in my life in IPO. You can consider me as fool. It's fine. You can think Sumit Rathi is fool. Why is he not applying to IPO? Many IPOs have, for example, Zomato had come up at 60, 70 rupees of issue price, but listing price was 130, 140, 150. I don't know. My boss was crazy when I was working in an earlier company. बोले यार तुम बेवकूफ वो IPO में नहीं लगा तो देखो मेरे पैसा डबल कर दिया मैं ठीक है सर आप करो. I am not here as a trader. That is your choice, right? I am a long-term investor.
Actually, when the Paytm IPO came with the issue price of 2,500, I was totally sure that this IPO will be flop because the Paytm doesn't have a huge price for its share.
तो समझ गए आप यही रीजन है इसीलिए वो आज 700 रुपए.
But my issue was that the issue price might be this is decided by the lead manager or the company with themselves. And we, the investor banker, work as a lead manager for this process. Okay, so how we decided the issue price? Like
so
there may be
it is decided based on supply demand factor. If people are crazy about your company, the valuation of your company will be very high.
So this might be the failure of the investment banker. You can
no, not at all. This is a failure of investor. Whose investment banker is not married to the company, my dear friend. Investor banker will come in the life of company for 3 months to 2 months, will come up with issuance and all. But आंखें तो investor को खुली रखनी पड़ेगी मेरे भाई. Investment bank का क्या failure? Investment banker ने फी बनाया, मौज किया, मस्ती किया, निकल लिया. करोड़ों रुपए का फी बनाया होगा. उसका क्या failure? See, investment bankers are not doctors, Mayank. Who are responsible for your life. They are responsible for their clients. They are responsible for their clients. They are getting money from their client. अब client बोलेगा investment bank को बंदर की तरह नाचना पड़ेगा.
But just like they are our clients, investor banker do also have a reputation in the market. Yeah, if something happened to this company like Paytm, and this happened to its process like this, then it might be a reputation failure for the investment banker also.
अरे ठीक है यार बातें बनती है मयंक इधर उधर बातें बनती है आप अगर इतना सोचते हो तो आप एक आर्टिकल लिख दो एक दिन पढ़ेगा दूसरे दिन पढ़ेगा but you try to understand market is not mathematics. Market is a combination of mathematics and psychology. So investors will even be fooled. It keeps on happening like that. The entire responsibility is of investor. There is no other party's responsibility over here. See, after getting cheated, you might feel like thinking कि नहीं वो गलत था, वो गलत था, वो गलत है. You would always try to pass this parcel कि भाई वो गलत है, ये इसका प्रॉब्लम है, उसका प्रॉब्लम है. अरे बहुत सारा प्रॉब्लम आप ही का है. If you didn't have greed, you would have thought like a sane man. Because you were greedy, you started thinking like an insane man. And in your insanity, you can do mistakes to the world. But you don't have the right to start saying कि नहीं वो उसकी गलती है, उसकी गलती. अरे बॉस अपना गलती देखो वो, है ना? तो ग्रीड को कंट्रोल में रखो, इन्वेस्टर की तरह सोचो. यू वुड मतलब even if these IPOs come and go, but you would not be affected or impacted largely. बाकी यार अब ऐसे अपन इसको if you want to make it a corporate sociology issue, you can make it. यार मतलब I have investment bank. तो I never worked in investment bank में, ठीक है? I myself never worked in investment bank. If you'll ask me my personal choice, Sumit, would you ever be like to work for investment bank even if you get 100 or 120% jump at your current price, at your current package? I would say no. I don't want to work. I want to sleep by 9:30. I want to wake up at 4 o'clock. I don't want to work more than, for my office, I don't want to work more than 200 hours a month. Right? In investment bank, you may have to work 400 hours a month. Right? So too much of greed. Investment bank is all about that. So अब आप अभी से नेगेटिव हो रहे इन्वेस्टमेंट बैंक एंड इन्वेस्टमेंट बैंक में करियर ढूंढ रहे हो तो फिर बहुत मुश्किल हो जाएगा.
No, I was just might be there is a
It's all a supply. देखो क्या है, अभी अगर आपकी कंपनी के पीछे लोग क्रेजी है, if people are crazy about your company, ठीक है, it's as like as a product, my dear friend Mayank. If you have come up with a product, people are crazy for it, right? कि भाई लाइन लगे खड़े हैं, मयंक आज सुबह प्रोडक्ट लॉन्च करेगा, रात को 1 बजे से लाइन लगना चालू हो गया है. People are waiting in queue to buy your product. Obviously, you keep the price is 1 lakh rupees per product, even if it costs you 3,000 rupees per product. It all depends on what kind of brand and craziness you have, right? In a trend of craziness, thing can go up. लोग $1,000 दे रहे हैं यार 1 किलो चाय का. आपको लग रहा होगा कि I am trying to fool you, but this is reality. Today 80,000 rupees per kg चाय का प्राइस है. समझ रहे हो? The same 1 kg tea can be bought at a price of 300 rupees. Reasonably good tea. Max 1,000 rupees यार, और क्या? People are ready to pay 80,000 rupees. Indian tea, organic, $1,000 priced for 1 kg. So it's all about the craziness and the brand and the mood you have around the product. You can, otherwise, what an iPhone should be priced? iPhone should be priced, you assemble everything, it should not be priced more than 10,000 rupees. Why is it coming at 1,50,000 rupees? Why people are going in the queue? You can say, नहीं, the company की responsibility बनती है customers को लेके. ये तो बेवकूफी है customers की. लेकिन आप बोलोगे नहीं, कंपनी की बेवकूफी है, कंपनी की responsibility है. People are here to do business, no charity. Okay. So investment bank are not some god people. If investment bank would have been god people, they would not have been working at a package of 1 crore or 50 lakh rupees or 30 lakh rupees. Right?
Yes.
तो इतना एक्सपेक्टेशन गवर्नमेंट नहीं है. हाँ, गवर्नमेंट नहीं है भैया, इन्वेस्टमेंट बैंक है. या आदित्य को
सर, ये जो वैल्यूएशन पे आते हैं, जब कंपनीज आते हैं वैल्यूएशन पे बिफोर लॉन्चिंग देयर फॉर द आईपीओ, सो ये वैल्यूएशन कौन करता है? लाइक इन्वेस्टमेंट बैंक करता है?
यस, इन्वेस्टमेंट बैंक सपोर्ट. इन्वेस्टमेंट बैंक कैन सपोर्ट ऑन वैल्यूइंग द आईपीओ. If company wants, and if company has its own perspective of valuation, then company can dictate, because I do not want to sell the shares below this price. Or if they want to take service from investment bank, both ways. Or they can involve a third party. Or they can involve a third party for valuing. I know some countries can have, their regulators can have a point that whenever you are deciding the price or the valuation of your company, you need to appoint a third party. But Aditya, simple सी बात है, देखो third party को भी pay कौन कर रहा है?
Company pay कर.
If company is paying, company is paying, the whole effect is diluted, right? हाँ. अभी आप जिससे पेमेंट ले रहे हो उसके तो आप चने खाओगे ना.
Yes, true, sir.
Right?
Yes,
You have
sir.
to work. So the whole structure is अब regulator regulation बनाता है, लेकिन उसमें फिर क्या है कि if regulator is saying कि boss you have to get it up by third party, तो regulation को बोलना चाहिए कि those who are interested investors they need to pay for it,
Yes,
right?
yes,
So
sir.
if investors are ready to pay for it, then the third party will perform the valuation in their favor.
Yes. हाँ,
Right? If the
valuation.
company who is paying them, तो फिर तो
Hmm.
क्या करोगे आप? समझ रहे हो?
Yes, understood, sir. Thank you.
Yeah. Right. Cool. Okay. Any more question, guys? Any more? Okay. So let's start our today's journey. Callable bonds. So we are entering into understanding various types of bonds which are there. So callable bond. So callable bonds are bonds, as the name suggests, they can be called by issuer at pre-decided price and at pre-decided time by redeeming and paying redemption value to investors. So just to give an example, a company issue a bond with a maturity of 5 years with a clause that we can call back. The issuer can put a clause that at that we can call back at 2 different intervals if we want at all. Those 2 intervals are second year and 4th year. If we called back at 2-year interval, then we will pay you 2% premium as redemption value. If we call back at 4% interval, if we call back at 4 years interval, then we will pay you 1% premium on the redemption value. And you have to give your bonds back. We will pay you your money. So though maturity is 5 years, and in case if we have not called at both the intervals, then the maturity will be the 5 years. It will remain 5 years, and the tie structure remain same. That you have to come back and give our bonds back, and we will pay you back after 5 years. Right? So 2 things are decided. Intervals are decided. The time needs to be pre-decided, and the price redemption value also remain to be pre-decided. That at what redemption value we will be buying back at what intervals. So issuer has the right to call back the bonds by paying them or redeeming them and giving the redemption value to investors at fixed intervals or pre-decided intervals. It is not arbitrary or random. That an issuer, if issuing callable bond, then those bond can be called back at any point before or on maturity. On maturity, so it's always going to be called back, so that is fine. But before the maturity, at any point, you can't call it back. So you, at the time of issuance itself, you need to give it clarity. Okay, what would be the time? What is the probable time where in which you will call back, if at all, if you decide to call back? So the issuer will say, we will call at all if we want to call back, either we will call back at the end of 2nd year or at the end of 4th year. In case we call back at the end of 2nd year, we will pay you 2% premium. And if we call back at the end of 4th year, we will pay you 1% premium. Now, if you want to buy these bonds with all these conditions, no, you can decide. There's some certainty. Okay, if I today buy these bonds, at least I will receive coupons for the next 2 years minimum. And at the time of, and at all, if it is called, then I will be paid 2% premium. So you can take an informed decision as a buyer of the bonds. So this is what callable bond is, right? Yeah.
Nehal here. So we had similar concept in cash equities also, right? Where issuer
Callable
can...
is a for, yeah.
Okay.
In case of preferred,
Huh.
whatever is whatever can be redeemed can have an option of callability.
Okay.
Right. So in not all kind of equities have this option, because equities, normal equities like common equities can't have this kind of option. Right?
Okay.
Preferred equity can have this kind of, because
Okay.
those are redeemable things, right?
Okay, thank you.
Yeah. Putable bonds. Putable bonds is giving an option to the investor. So investor can come back and sell those bonds back to issuer at any point in time. Option, not an compulsion. It's an option to investor that at any point in time, if you want to come and get your bonds redeemed before maturity, you can come. Right? So those are putable bonds. So callable bonds give the option to issuer, and putable bonds give the option to investors. These are the two difference between callable and putable. In callable bonds, the option is with issuer. In putable bonds, the option is with investor. Callable bond is something which can be called back before redemption at pre-decided time by issuer. Putable bonds are the bonds which can be sold back by investor to issuer anytime they want before the maturity.
Why would companies do that, Sumit?
So, interesting question. See, it all depends on the credit worthiness of the company. Suppose you are a company which nobody wants to invest in. Okay. So you come up with an attractive option ki theek hai boss, we are adding a putable clause in. If you at any point in time, if you lose trust in us, immediately we will give you back money back. Give us bonds. You come and give us bonds back, we will pay you money. So it gives flexibility. One important feature which we have talked about sometime maybe is liquidity. Have we talked about liquidity as a feature? Anybody remember liquidity as a feature?
I don't remember.
Anyone?
Yes, sir.
What is that? Can you tell?
So easily converted into cash. Oh,
Yeah. So this is adding to the liquidity of the bonds, because now you can easily convert into money at any point in time you want. If, for example, an issue is coming with a 5-year maturity, that means and if there is no secondary market for that, right? Exchange is not there for trading of those securities, then it is a very illiquid asset, right? Then you'll have to wait for all 5 years for the company to come back and pay you back and get the bonds back, right? Now you have a liquidity. Even if there is no robust secondary market or exchange for the trading of these kind of bonds, you can directly go back to issuer itself and say, boss, mujhe mera paisa do aur aap apna bonds do. Yeah, go ahead. I know you have a repetitive question.
So, in what about the callable bond? Why do they have?
Callable bonds are the bonds which can be issued by the issuer who think that we need money for 5 years, but उधार का पैसा एक अच्छे आदमी को उधार का पैसा क्यों चाहिए? मुझे सोचो आप मुझे.
Okay, so they want to pay back their debt.
यार जल्दी आ गया तो जल्दी चुका दूंगा ना, फालतू में इंटरेस्ट क्यों भरूं मैं?
Okay.
Are you getting it? So they're putting a clause of why should I keep paying interest for 5 years if I'm hoping. See, I am preparing for the worst, that is 5 years, that I'm getting this money from the investor today, but I will be in the position to pay back after 5 years only. So what I'm doing is I am preparing for the worst, but I'm hoping for the best. What is that best? That somehow I feel that I would be able to be in a position to pay back this loan within 2 years itself. So 3 साल का interest बचेगा ना, मैं interest क्यों भरूं फालतू में? So if you are in a position like that, you can opt for a callable bond.
Okay. Thank you.
So you can pay back and you do not have to worry about paying interest, right? Interest is a cost to the company, right?
Yeah.
So you can save yourself from it. Same options are there in your home loan. यार एक normal देखो, there are people who take home for loan for traveling and honeymoon पे जाना है, travel करेंगे, ये करेंगे, वो सब के लिए लोन लेते हैं. मतलब मुझे वो सब बेवकूफी लगती है. But then I don't have the right to judge on each and every aspect, right? I should not be, and you should not be. No one should be.
You mean,
but there's something for which, but there are something for which it makes good sense to take loan. For example, for buying home, right? for buying home, it's reasonable that you take loan, right? You take a home loan with a tenure of 30 years, but it always have a clause of prepayment.
Yes.
That if you want to prepay back, you can bear. That is nothing but a clause of callability. That as a person, you are taking loan, right? But if you want to come back, give back that money before its scheduled time, you can do that because it is allowed.
Okay.
Right?
Thank you.
No, it's okay. नहीं अभी हुआ नहीं अभी चल
Oh, okay.
सुनते रहो, ठीक है?
Okay.
Right? But not on all banks and not on all types of loan, prepayments are given as an option without any clause. So for example, if you ever, has anybody ever taken a personal loan from HDFC Bank? Anyone?
I have.
So for example, if you want to prepay that, you would have to pay more than what
Yeah,
you have
I did
scheduled to
that
pay.
too, Sumit.
Right?
Yeah.
Why do you think there is a prepayment clause? Why do you think so?
Because they want to, they're losing their capital, what they have with them, right?
नहीं कौन
नहीं,
capital
sorry,
lose कर?
sorry.
They will get their money back. उनको तो उनका capital वापस मिल रहा है बैंक को. Then why are they charging higher price? If don't you think it's a good thing for a bank? If somebody whom they have given loan, there is always a risk now that person will come back and give my money back or not. Yeah, but there is a person who is ready to give back money earlier than, so don't you think it's good for bank? They're getting the capital back before, so they do not have to worry. So for example, 5 साल के लिए loan दिया, you are given loan for 5 years, so you have to worry for 5 years. What if he defaults or she defaults? Now somebody is ready to give you your money back in 2 years itself. Don't you think it's a matter of you will have less worry for the next 3 years? In scenario 1, when the person will come back and give you money in 5 years, you will have to worry for 5 years, right? In scenario 2, the person is coming back and giving you money in 2 years itself. Then you would have to worry only for 2 years. That is less by 3 years. Yes or no? Huh? So don't you think it's a good thing for a bank?
Well,
Still,
they
why do
lose on
you
their
think they
steady income of interest.
So more than steady income, there is this concept of asset liability management, ALM. ALM, asset liability management. Okay. So what happens is that when you have taken a loan for 5 years, so bank would have also taken money in the form of deposit from someone for 5 years, right? Right. So while accepting the deposit, they would have promised him something. Okay. For example, you took a loan of 5 lakh rupees. Bank is not a person. A bank is not something with a money plant.
Yeah.
Right. You asked for 5 lakh rupees to bank. Okay, come tomorrow. And one day they would water the plant, and suddenly 5 lakh rupees will come, and they will have 5 lakh. It's not like that, right? So if you go to bank to take 5 lakh rupees of loan, they will say you have to pay 6% interest, for example. Okay. Then they will go to their salespeople, or someone will go to someone like, or come to someone like me, who do not take loan but who have money, to always money in the form of savings. Okay. So he'll come to me. Sumit, if you give us money, we will pay you 4%. I say okay, right? Money lying idle in my at my home. I give to bank, I get 4%, right? So I say okay, but for what tenure? Okay, you deposit in fixed deposit for 5 years, we will pay you 5% rate of interest. If you give it for 1 year, we will pay you only 4%. I say okay, take it for 5 years. I'll get 1% extra, right?
Right.
So I have given bank money for 5 years, on which bank have to pay interest for how many years? At what rate? 5% per annum. Okay. How would bank pay 5%? How would bank pay 5% interest?
If someone has taken a loan and that person,
you have taken a loan for 5 years now, and you are going to pay 6% to bank, right?
Right.
Yes or no?
Yeah.
Yeah. The same money you have taken from bank, and you have promised to pay 6%. Now bank will receive 6%, pay 5%, and enjoy with 1%, right?
Right.
Right. That is whole game. Now the problem comes when Nehal comes and prepay in 2 years itself. Nehal can do that, but bank cannot come and prepay to Sumit, because it's a matter of reputation of bank. बैंक सुमित के पास आके नहीं बोल सकता है कि आप ये 5 लाख रुपए वापस ले लीजिए, अब हमारे पास इंटरेस्ट देने के लिए पैसा नहीं है, मैं कहूंगा फिर तो मेरे पास आए क्यों भाई, मैं कहीं और जाता ना। जब तुम्हारे पास कस्टमर ही नहीं है, तुम्हारे पास पैसे कमाने की हिम्मत ही नहीं है, तो फिर मेरे पास क्यों आते हो लोग पैसा लेने के लिए? नेवर एवर कम बैक टू मी। बैंक विल लूज इट्स रेपुटेशन, राइट?
Right.
Because as soon as you stop paying interest, how would bank pay to me as interest? It creates a problem of asset liability mismatch. Bank has an asset in the form of Nehal and liability in the form of Sumit. To their liability, bank has to pay 5%. From its asset, it will receive 6%. It will enjoy with 1%. That is why bankers are one of the richest people in the world, because they enjoy with people's money, right? Their investment is zero. People's investment. But this is a problem. So in order to make it unattractive for you, they will say, boss, you're taking loan from me is fine, but if you come to prepay, you will have to pay 5% extra, 10% extra, whatever, right? So it would not make sense for you to prepay even if you want to prepay, right? They would punish you for prepay.
Yeah.
That is against all logic, because when you give to loans to someone, you always want the money to come back to you ASAP. But then this is the problem, right? So that is why they would make it difficult for you to prepay, and same they would make it difficult for me also, Nehal. If because bank will not come and pay back my money back to me before 5 years, but bank will give me an option. If you want to get your money back 5 lakh rupees before 5 years, Sumit, you can come back anytime, and we will pay you money, but we'll charge you 1% or 2%, whatever. If you break FDs before that tenure, you get a charge, right?
Yeah.
You get a punishment of 1%. Right? So that is why these kind of charges are to manage their asset liability mismatch. Right?
Okay.
So similarly, if you see in this option also, investors are ready to invest into this, but in order to enjoy callable option, issuer is giving a premium. At all, if we pay you earlier, then we will pay you 2% extra. For example, you paid back your personal loan to bank, you paid some percentage extra, right?
Yes.
Similarly, issuer is ready to pay some percentage extra, then only investor will invest. Otherwise, investors will say, boss, why? I have invested seeing your interest rate at this percentage. Okay. Suddenly, interest rate goes down in the market. You will prepay our money. And now we will not be left with an option to invest the same money at that higher rate, because now the interest rate is lower. So we'll have to suffer on the interest rate. You invested 1 lakh rupees with the company called Reliance, assuming that Reliance will pay 9% per year for 5 years. Okay. After 2 years, interest rate went down in the market to 7%. Reliance comes and give your money back to you. What is the loss? The loss is for the next 3 years, you can invest at best at 7% only. Yes or no?
Yes.
And if Reliance wouldn't have come back to you and gave that money back to you, then you would have kept on enjoying 9%, even if the current market rates are going on at 7%. Yes or no?
Yeah.
Right? So investors are at loss. Investors say, why would I subscribe to this option? You can come back and give our money back at any point in time, and then we would not left with an option to invest at such superior rate in the future. So make it attractive, make it a sweetening deal for us also. So they make it sweetening by giving a 2%.
Okay.
The investor say, okay, ठीक है, तुम 2% extra दोगे, तो चलो मैं आपको मैं subscribe करता हूँ.
Okay. Thank you.
Right? Yeah. Okay. So this was with respect to callable and puttable bonds. Any question, guys? Anyone? Okay. Convertibility. A bond can have a convertibility option. Just give me a second. Just give me a second, guys. I'll unshare a screen for a second and I will join you back. Just give me 1 minute. All right, sorry. I had received a very important thing. I had to see that. Sorry for this intervention, guys, and I could keep the screen share. Sorry for that. Yeah. So on convertibility, am I audible?
Yeah. Yes, sir.
Okay. So convertibility, as the name suggests, has a conversion option where bonds can be converted into common shares at a pre-decided time on some pre-decided event. Similarly, we had something like this in preferred case also, right? That preferred shares can be converted into common shares. So like in case of preferred shares, here also there can be two types of conversion, mandatory conversion and optional conversion. Mandatory conversion, as the name suggests, investors will have to convert the bonds into equity mandatorily at a pre-decided time. Optional conversion is investor gets an option to convert into common shares at their wish before the maturity. Because at the maturity, if it remains unconverted into common shares, then at the maturity, the money has to go back to investors and the bonds needs to go back to company, right? So up to maturity, investors has the right to get it converted into common shares. So because it has a right or an option, but it if investors do not want it, it's their choice. Mandatory, they would have to be converted mandatorily into common shares at some pre-decided time. So that's the option of convertibility, where bonds needs to be converted in common shares based on mandatory or optional conversion method. Secured or unsecured bonds can be there. Secured bonds are the bonds which remain secured against the asset of the company. So if company tomorrow goes to insolvency, that particular asset which has been secured to raise the capital, that asset will be sold and the money from that asset will be only utilized to pay back the bond holders, that specific bond holders on. So that is a kind of security. It's like a secured loan. For example, secured loan in a bank. If you have to take a secured loan, you have to keep security like gold loan. So you give your gold to security as a security to bank, and bank then, in case if you are not in a position to pay back, bank what it does, it sells that gold and gets its money back, right? So those are like similarly, so the same things happens in the case of bond also, that while issuing bonds to people, companies put a particular asset as security. It can be a factory, it can be a land, it can be machinery, it can be anything. Put that thing as a security to a trust, and that trust basically, because because general public, when they are buying bonds, ownership, it's not like taking loan from a bank where you are dealing with only one party. When you are issuing bonds, you are dealing with multiple investors, so it's impossible to give the authority of that asset to multiple people. So they put it in a trust format, and the trust is representing the investors. So it keeps the ownership, the authority of selling the asset and give the money back to investor in case if company goes for insolvency or company defaults on those bonds. So that is secured bond, and unsecured bonds is unsecured, means no assets are kept as security for the issuance of those bonds. Yes, Shubham, common shares means equity shares only. Okay, Shanaz, I got it. You are in office and I will mark your attendance. So guys, I got these messages on the chat personally, so I just responded to them. Okay, any questions so far? Any question?
Sumit, this optional conversion, can you please explain one second? Hello?
Sorry, what did you say? Optional?
Optional conversion. Can you please explain once again?
Simply, the option of convertibility remains with the investor if investor ever wants to get it converted before maturity, because that option cannot stay after maturity, right? Because after maturity, the security will not be into existence. So before maturity, at any point in time, if an investor wants to convert their bonds into equity shares, common equity shares, they can get it converted through company.
And this clause will be added in the bond itself.
Yeah, in the bond itself. If it is a mandatory conversion option or it's a optional convertible feature, whatever the feature is, it will be part of that contract.
Okay. Okay.
Bond is nothing but a contract.
Yeah.
Security, everything is a contract. All these are legal contracts.
Yes.
So everything will be written as a part of those contracts or conditions of those contracts.
Thank you.
Okay. Market rate. Market rate is the rate which is currently going on in the market for similar kind of securities. It keeps on changing based on market dynamics or supply and demand of fixed income securities and investable money. Right. So market rate is a rate which is going on currently for the similar kind of securities. And as I said, it keeps on changing based on the market dynamics. Market dynamics is nothing but the supply and demand for how much money is available for investment and how many securities are available for investment options. So if there is a lesser number of securities and more money, the market rate will be lower. If there are more number of securities and less money, the market rates will be higher. So the market rates keeps on changing based on the market dynamics, right? So that is market rate. So issuer with a credit rating of AAA issue bonds with 15 years having a coupon rate of 10%. Just an example. And we'll see how market rate has an inverse relationship with the value of bond. Because market rate and bond has inverse relationship. Let's look at it. If an issuer is coming up with an issue of a AAA bond with 15 years having coupon rate of 10%, then what is the coupon rate it is offering? Issuer is offering 10%. And in that time, the market rate would also be 10%. That is on year 0, at which issuer is coming to issue the security, market rate would be same as coupon rate. In fact, coupon rate will be decided based on what current market rates are going on. But if it can happen that after 10 years, the market rate is currently 10%, 12%. But will the coupon rate change? Because this issuance is for 15 years, would the coupon rate change on that security? Coupon rate can never change. Coupon rate is a contractual rate. At the time of issue, whatever rate is promised by issuer to the investor, that will remain same till the maturity. Right? But the market rate for similar kind of securities currently maybe 12%. So what we are trying to say is that at the time of issue, coupon rates generally revolve around market rate, but over the tenure of the securities, market rate and coupon rate can be widely different. And that is why the market price of securities keeps on changing. It's a function of market rate. Market rate, you can see it as yields also. So after 10 years, if market rate and coupon rate remains 10%, then the price of bond will be equal to the issue price. But if market rate is higher than the coupon rate, think about it, guys. If market rate is higher for the coupon and than the coupon rate in the year 10, and you are holding those securities with a coupon rate of 10%, the market rate currently going on is 12%. And if you want to sell that security into secondary market, will there be any investor buying your security? Will there be any new security investor who's ready to buy your security? Think about it. A security which is offering a 10% rate and the market rate going on is 12%. And if you want to sell that security with 10% coupon rate in secondary market to another investor, do you think any investor would be ready to buy? Or any investor would like to buy it? Huh?
No.
Why no, Surbi? Yeah, you are correct. It would rather what?
He would rather buy it from the market than buying it from me.
At new securities which are coming up with 12%, right? You would rather buy that, right? So what will you have to do in order, in case if you are still in need of urgent money, what will you have to do if you still have to sell it? Think about it. What will you like to see if still you need money? No one is ready to buy. If still you need money, what will you have to do? What option you have to follow to sell it? What strategy you have to follow? Surbhi, can you hear me?
Yeah, Sumit. But I don't have an
What
answer.
strategy?
I don't know.
You have to reduce the price. As simple as that. Think about it.
Yeah,
You will say what? You will say what, Surbhi? You will say, see, the market rate is 12%, right? I'll make it a price, though the bond issue a coupon of what? 10%. And the issue price is 1,000 rupees, for example, or the par value is 1,000 rupees, on which interest is 10%. I will make the price as such that even that 10%. So what is that coupon which company will pay, Surbhi, and you need to go on mute. Please go on mute because there's a lot of background noise coming from your side, Surbhi. Please go on mute. Yeah. So Surbhi, just listen to it. See, at 10% coupon, as an investor, how much would you receive from the company as interest every year? You will receive 10% coupon on the par value, that is 100 rupees. But currently, the new securities which would be coming up in the market will be coming at 12%. So I will have to sell the securities in a price less than 1,000. That is clear, right? But what price? I would keep the price as such that the return remains 12% on the investment value for new investors. So that means what should be that price? That price would be nothing but 833.333. I will have to reduce the price to 833. Then only any investor would be ready to buy these securities. Yes or no? Because when they are even if the security par value is 1,000, but if those securities are readily available for you at 833, would you be indifferent? Would you not be indifferent between these two options? Investing 833, receiving 100 rupees of interest, or investing 1,000 and receiving 120 of interest? Will you be different or indifferent between these two options? Tell me. Louis, why not you try it? Let Louis try it. If you have two options, Louis, that is investing 833, receiving 100 rupees of interest, or investing 1,000 and receiving 120 rupees of interest, will you be indifferent or different in your opinion? Will you choose, while choosing this, will you be indifferent or different in your opinion? Tell me. I guess Louis is not listening to us. Maybe he's on break. Anyone else?
No.
Oh, you're there. Okay, yeah.
Sumit, I'm not.
Yes.
But it should be indifferent, in my opinion.
You will be indifferent, right? Sorry? You said
that
what?
is right.
You will be indifferent. Why? Why you would be indifferent? Because in both the option, you are receiving 12% rate of return, right? Even on this 100 on your investment of 833, you are getting 12% rate of interest. And even on this case also on investment 120 on investment of 1,000, you are getting a rate of 12%. So you will remain indifferent. So Surbhi, you will have to reduce the sell price to a level where investors are ready to buy it in the secondary market.
Yeah.
So that is why we say, when interest rate goes up, market price will go down. for bonds, for existing bonds, which are already there in the market. When interest rate goes down, the market price would go up. Because, for example, if the new securities, if the market price now should be, if you twist it to another situation, wherein the market rate going on is 6%. What is the market rate going on? 6%. And you are having securities with the issue price of 1,000, par value of 1,000, which is giving you an interest of 10%. But the market rate currently, where all new securities are coming up, are giving and offering a rate of 6%. Tell me, if you have to sell, would you ever like to sell these securities, first of all?
Yeah, sure, I will.
Sorry? Why would you like to sell these securities?
Because I can sell my bonds at a 10% coupon rate in the market, for which I'm currently having a 6% interest only. So I would sell
I
it
guess you are not understanding it. So in the market, people are offering 6% on money, and you are holding
okay.
something which receives 10%. So why will you sell?
Got it now. So I can sell it. Can you repeat it again?
Yes, understand my question. See, in the market, the new offerings are coming up with a 6% interest, right?
Okay.
You are already holding something which offers 10% to you.
Okay. So
if at all you have to sell it,
okay.
If at all you will sell it, will you sell it at same price of 1,000 at which you bought it, or higher price or lower price?
Higher price.
Why higher price?
Because market is only giving a lower interest rate.
Right. So if any investor buys it from the market, will receive only 6% only. But you are holding something which offers 12%. So you will adjust the price where the actual return for new buyer goes to 6% only, right?
Yeah.
Right. So you will adjust it upside this time. So you will change the price to, so for example, you are receiving 100 rupees of return. So you will change the price to 1,666.667 rupees, right?
Yeah.
At all, you will never be interested to sell this, because this is like you are holding gold and everyone is holding silver. Will you replace gold for silver?
No.
But at all, if you have to replace it, you will ask for more and more silver for that same amount of gold, right?
Correct. Yeah.
So here you would ask for higher price, right?
Yeah.
So when market rate goes down, then existing securities which are traded in the market, their prices go up, and you need to go out mute again. There's a lot of background noise. When market rate goes down, existing securities which are traded in the market, their prices go up. When market rate go up, existing securities which are traded in the market, their prices go down. So there is an inverse relationship between bond price and market rate. There is an inverse relationship between bond price and market rate. Inverse relation. Do you understand this? Market rate and bond price, there is an inverse relationship between market rate and bond price. Do you guys understand this? Tell me. Go on. Tell me.
Yes.
Yes, sir.
Okay. Anyone has any question? Anyone doesn't know. Come on. Interesting. So I explained it to a level that everyone understood it. Even I am surprised. My wife says, come on, yeah, this is impossible. I told this to my wife also. That nobody asked questions in this batch, other than a couple of people like Neil and Sulpi or maybe. So see how well I teach. And she says it's impossible. This can't happen. I trust her. This can't happen means that you understand it to that level that you don't have any question. Because understanding itself is the seed of question. You know it, Neha? Understanding itself is the seed of question. Okay, Prasad, I got your message. Please go ahead with your personal commitment and I will take care of your attendance. Yeah. Neha, the understanding itself is the seed of this, right?
Yeah.
Because when you start understanding,
then only
it starts resulting in questions in your mind, right?
Yeah.
Those who do not start understanding, they will never have questions, right? तो ये थोड़ा सा मेरे को लगा, मुझे लगता है इसके पीछे कारण है सोशल मीडिया. मतलब आई एम नॉट एंटी सोशल मीडिया ऐसा, बट हाँ सोशल मीडिया है कारण. Because we all have got into this habit of consuming content rather than creating content. You know, on social media, 9% of the people create content and 91% of the people are only consuming the content. Do you know this? Anybody? Has anybody an idea on this fact? That only 9% of the people create content, rest 91% of the people are consuming content.
Yeah.
You know, only 9% of the people are making tons of money because there are 91% of the people who are ready to give their time. Your time is equal to money for them, right? And this has become such a passive consumption, has become such a passive thing that we started consuming everything very passively. Even we eat food passively. Our children eat food passively. So I have a very young daughter. She's doing everything very actively right now. She's just 1.5 months. But I see people around, my friends and all, right, who have children 3 years old, 4 years old. They consume content and they eat food. So they're eating passive. So being passive has become our habit. Guys, come on, come out of this passive habit, because this is the most dangerous thing in this world. I know I don't have the right to say on your personal habits and all, but try to understand, being passive or remaining passive is the death of us. The day we become passive is the death of us. That means we are not living in this moment, because if you are living in this moment actively, questions is the natural outcome, Nehal. Question is the natural outcome, Nehal. It has to be. You can talk to any psychologist or any doctor or anyone. If you are doing things actively, your mind will throw questions to you. If you are doing things passively, there is no question that a question ever will arise. So question ka bhi koi question nahi. So guys, please take this very seriously and become active. Okay. The next concept is the concept of zero coupon bond. So far, any question, guys, before we go to the next concept? So there is an inverse relationship between market rate and bond price. Next question is zero coupon bond. Any questions so far? No? Then let's learn it. So what is zero coupon bond? The name is itself tells you it's a bond which is issued with zero coupon. Now think about it, anyone. If I issue a bond and I tell you that please buy these bonds, subscribe to these bonds, and I will pay you zero interest or zero coupon rate, will you ever like to buy it? Anyone? Would you ever like to subscribe to a bond which gives you 0% interest rate?
Not at all.
Then why there are products like zero coupon?
Because they are issued at discount price.
Brilliant, brilliant. So you have just stolen the fun out of it. Otherwise, people would have really thought about it, but you have just answered it so early that people didn't get the time to really think about it.
No, I still didn't understand, Sumit. Sorry.
So still we have people. Okay, Shubham. So still we have people, some people who need our help. So that's a matter of pride. Great. So see, as such, Nehal, nobody would like to subscribe to a bond because it is not equity, right? It is a bond. So you know it is a debt product. And when you put money into debt, you obviously accept an interest, right, on it. So it is unbelievable that you issue a bond without any interest and people subscribe to it, right?
Right.
Still, there is a product called zero coupon bond. So why is it possible? How is it possible? How is it possible that there's a product like zero coupon bond which itself defeats the purpose of it? Nobody would subscribe to it ever. So there are products like this, and they become possible, Nehal, with the discount rate at the time of issuance and redemption at par or maybe premium. So I issue a bond with a par value of 100 with a discount of 50%. Tell me, what is the price you have to pay to subscribe to that bond?
Please repeat. You issue at
I issue a bond of 100 rupees par value with 50% discount. Then what would be the issue price?
oh 50%. Okay, 50.
50 rupees, right? So 50 rupees will be the price. And I tell the redemption value will be 100. That is, redemption will be at par.
Oh, I'm getting.
So you are paying me how much?
I'm
You are
paying
paying me how much?
50.
And after 5 years, you are receiving how much?
100.
Aren't you doubling your money?
Huh.
When you double your money in 5 years, you know what is the inherent interest rate you are receiving. Though you are not receiving at fixed interval of 1 year, but still there is an interest rate inside it. What is the interest rate? You know, here comes the rule of 72. The rule of 72.
72. Okay.
So I'll tell you what it is. For example, if your money gets doubled in 5 years, you know what is the annual rate of interest you are receiving? 72 divided by number of years in which the money is getting doubled. That is 5 years is getting doubled, right? What is the rate of interest you are receiving? 14.4% per annum. That means if 50 rupees is invested and it receives a 14.4% per annum interest, then only it will become 100 after 5 years. Let's do the calculation. At the end of the first year, it will become how much? With 14% interest rate, it will become
770 something.
57.2 rupees. Because at 14% interest rate, you will receive how much interest? 7.2 rupees, right? So your total capital will become how much? 57.2, right? Right? And then second year, it will become how much? You will receive interest on 57.2, right?
Yeah.
So it will become how much? 65 rupees. So that means the interest you will receive will be how much? 8.2 rupees, right?
Okay.
And the third year, it will become how much? You will receive principal amount will become 865, right? So you'll receive, it will become how much? 74 rupees. The interest you received in that year is how much?
9.1 something.
$9.4. So basically, the difference between these two values. Right? So now comes the fourth year, and fourth year you will receive in your value will become how much? Why? Because you're receiving interest on
74.
14% on 17.5, right? So that year you receive 10 rupees of interest. That is nothing but the difference between 85 minus 74, right? Right? And end of fifth year, it will become how much?
It should become 100.
It will become 100. Right? So this is an approximate calculation. 72 divided by 5 is what? Approximate. Quick and approximate, right? So we are receiving approximately at the correct value, right?
Yeah.
If you want to know exact value, that also we can calculate. Just give me a second. So the interest received for that year is how much? Amount of interest? Around 85 you will receive, right? And it will become So approximately you have doubled your money, right? From 50 to 97.97, that is 98, right?
Yes.
Exact value we can always calculate, right? That
Concept, but yeah.
Understood the concept, and exact value would be, exact value would be, we can always check. We can go to this data, what if analysis, goal seek, and we want to make this 100, right? This value should come 100, right?
Yeah.
So by changing this value, that is 14.4%. So exact value is 14.86982%. Exactly. So by using the principle of 72.5, you can do a quick calculation. You can say 14.4, but yes, it is not exactly the value. You would exact value is 14.86%, right? So you are approximately correct, right?
Yeah.
Now you are getting 99.99993, which is X. You can do even more perfect, you can change it a little bit more, and you can do goal seek once more. It can only run that much iteration. So for the value, change this value to 100 by changing this 18.86, and this is what the best value they can get. It is 99.99993. This is equal to 100, right? You change this rate to maybe, see, only these many decimals they have changed. You can do this iteration. We can change the number of iterations somewhere in the Excel. You can do the system, in the function, and you can change the iteration from options mein jaake, from maybe I have done 100 iteration. That is why you can make it 1000 iteration. Advanced mein jaake, I forgot where is that option. Language proofing data formulas. Yeah. Enable iterative calculation and make iteration more than 100. So it will exactly reach to 1000 also. Make it 1000 iteration. Okay. So this is just Excel thing, right? Now you do this, apply this formula, it will exactly come 100, I believe. Goal seek, change this value to 100 by changing the value. It is not coming, it's fine. But exactly it is 99.9. You get the meaning, right?
Yes.
Okay. So the rule of 72. For example, 50 is becoming 100 in 6 years. Then the rate, the approximate rate at which your money is growing will be how much? 72 divided by 6. Because 6. Because your money is getting doubled in 6 years, right?
6 years.
If money is getting doubled in 6 years, what is the rate? Inherent rate in that? 12%. What is the inherent rate in that? 12%. Right?
12%.
So you can get an approximate idea that what is the inherent rate. So even if it is not offering you interest every year, still you are getting an inherent interest because it is coming at a discount, and at a steep discount, right? And the redemption is at par. So zero coupon bond become possible. Why? Because issue will be always with discount, and they would get redeemed at par or maybe at premium. Generally at par. Okay. Right. Now, again, still investors will say, "Nahi, it's always better to receive interest every year than receiving interest cumulatively after 5 years." Why? Because there is a risk, time risk, right? What if after 1 year you are solvent, but after 5 years you become insolvent, right? So it's better you receive your interest ASAP, yes or no?
Yes.
So still these kind of products are there. In order to issue a zero coupon bond, you have to be someone with a very high credit rating, or you are yourself a government. Generally, government issues zero coupon bond. So the trust issue is not a problem at all, right? Because if government defaults means the entire country defaults, the country is no more livable, right? So you should either leave the country or you should die hungry. These are the two possibilities, right? So generally, government comes up with zero coupon bond. Or there can be other reasons for that. But you know, one of the biggest reason for companies to come up with zero coupon bond is maybe they are investing into projects where immediate cash inflow is not there. There is gestation period. For example, coming up with a power plant. Now, you know, setting up a power plant itself takes, if it is a hydropower plant, setting up the hydropower plants itself takes 6 to 7 years. Are you getting what I'm saying? With delays. Without delays, it will take 4 to 5 years. Okay. And delays are natural. Why? Because the hydropower plant are set up in the areas where there is too much of flowing water, right? And where there is too much of flowing water, there is always, once in a couple of years, there will always be heavy rain and there would be always the chances of floods. Because of which things will be delayed. What is already constructed will get deconstructed and you will have to reconstruct it, right? So delays are natural in hydropower plant. So with delays, practically it will take what? How many years? 6 to 7 years. So for that 6 to 7 years, will there be any power generation? No, only construction will be there. And if there is no power generation, can hydropower plant generate cash? Because how would hydropower plant would generate cash? By selling that power. Electricity बेच के पैसा आएगा ना? Yes or no?
Yes.
And if there is no cash inflow, will they be in a position to pay any liability? Forget about interest, anything? No. So that is why you know, these kind of companies can come up with zero coupon bonds. So there is a reason why zero coupon bond comes. So they pay interest together, you know, in the form of a par value of redemption, but take lower money, you know, at the time of issuance in the form of discount. Shubham, you raised your hand. Please go ahead with the question.
Sir, I was about to ask the same question because I was asking that is it feasible for a company to issue zero coupon bonds, because I think there will be
Every
a burden
company
on
would like.
companies.
So it is feasible. See, it is not a feasibility of company. It is always feasible for company, right? अच्छा है ना, company को interest नहीं देना है 5 सालों में, तो cash outflow for the 4 years at least will be zero, right? So it's always good.
Yes.
For company, it's
But-
always feasible. For investor, is it feasible or not? That's a question. To really invest
don't
in this kind of security. Yeah, go ahead.
But I think at the end of the period, there will be a burden on the company to pay the lump sum amount.
So there is always a burden on the company, right? But for those 5 years, it can enjoy that money, yes or no?
Yes, correct.
So burden is lower. Why? Because now you every year you do not have to worry about paying back. So you have time as your advantage. In any year, if you ever incur a loss also, you would not be in a burdensome situation now that you have to pay, because if you incur loss, how will you pay interest? Are you getting what I'm saying?
Exactly.
Then in order to pay interest, you'll have to take loan. So if there is no liability to pay interest every year, so in any particular year, because of some sudden dismay, you had losses, still you do not have to take loan for that, right? Why? Because you do not have to pay any interest on it, right?
Exactly.
So you would always be in a very relaxed situation because time is at your playing for. So you would always be comfortable taking this kind of securities, but the question is, investors, is it feasible for investors to really invest into it? And the answer is no. And that is why investors, if at all investing into zero coupon bond, they have to see they are getting best discount possible. Second, the issuer is the best credit rating or the government itself. So they have to have a very high comfort level with the issuer. Otherwise, they would not. They would never invest into this security. Okay.
Got it, sir. Okay.
Yeah. Okay. All right. Anyone has any more questions? Anyone has any more questions? Tell me.
Sumit,
Hmm.
can you please describe us or give us some of the examples which company till now has issued some kind of zero coupon bonds?
See, government has issued many types of zero coupon bonds. Okay.
Okay.
Companies, I don't know, because obviously investors would not be comfortable investing into zero coupon bond for when it's coming from companies, because too much of risk. Yeah.
Okay.
So I'll tell you. I'll also have to check online already when government has come up with zero coupon bond, but they have come up with zero coupon bond for many times.
Okay.
See, RBI orders 5 banks to list zero coupon bond at fair value. So banks also issue zero coupon bond for that. So banks have also issued it. अभी एग्जांपल या दिख नहीं रहा है भाई, लेकिन बहुत एग्जांपल्स होंगे. See, government has issued zero coupon bonds to public sector companies, right? So issued at a deep discount to the face. Government capital infusion via zero coupon bonds positive for PSU banks, right? So they have invested money, they've given money to PSU banks at a zero coupon bond level, right? That means PSU banks will not pay them interest, but will pay the principal back, which would be higher, right? Redemption value would be higher than the discount. You understand what is zero coupon bond? So see, issued at a deep discount to face value, these bonds are non-interest bearing. This means it's an investment that does not earn any returns, but depreciates in value over the years. So the depreciation itself is a return basically because it's coming at a deep discount, and redemption will be at par, right? So see, government. So generally, government only deals with these kind of securities. Normal companies to really get into it, nobody would like to invest in that. It's too much of risk, right? Yeah. Any more questions, Gagan?
Yes, Sumit, I'd like to ask one question. If governments or if any organization is issuing zero coupon bond and they are actually issued at a discount rate, so how a general public or any person who's investing in gets to know what was their face value?
So the face value will always be written on the bond itself. That's how discount value will be calculated, right? I am saying that I am offering you a discount. You would always ask me what is the actual price so that you can find out what is the discount. Abhi you come to me, okay, to buy a shampoo bottle, okay. I say, sir, ले लीजिए 90 रुपए की है, discounted price है 90 रुपए. You would always like to know ना कि कितना percentage discount है. So in order to calculate कितना percentage discount है, you have to have the MRP in your head, yes or no?
Yes.
I will tell you what is the MRP. Then only you will be able to find out. मैं बोल रहा हूँ MRP 90 है और I am selling it at discount at 90 rupees. You will say, sir, क्यों बेवकूफ बना रहे हो? 90 रुपए का MRP है और आप बेच भी 90 रुपए में रहे हो, तो डिस्काउंट क्या है? Right? तो issue price से बताना ही पड़ेगा ना. तो how exactly they would come to know is नहीं. वो तो at the time of issuance itself all these conditions need to be clearly told कि issue price कितना है, फिर par value कितना है, par value 100 है, issue price 50 है, तो मतलब discount 50% है.
Okay. Cool. That was my question. Thank you.
Yeah. Any more questions? Now, perpetual. So again, I don't think it requires a lot of explanation because we have seen some similar kind of products in case of preferred securities also. Like if generally these kind of bonds would be very limited and issued by government only. But perpetual bonds will be the bonds which will keep giving you interest till your life, but you will never get your money back. So those are perpetual bonds, right? So bond on which you will once you invest, you will keep receiving interest. That is a perpetual bond. The bond where there is no maturity. The maturity is the death of the person who is holding those bonds. He dies, the bond dies. As simple. Right? So perpetual bonds means bonds with no maturity, issued and keeps on paying interest every year. This is more of a theoretical concept for companies. No companies I know would have issued perpetual bonds, or nobody would subscribe to those bonds simply. because you're not investing into equity, common equity, right? You can invest into common equity with the perpetuity, but with bonds, you would not like to go with this kind of concept. So perpetual bonds, deferred bonds. Now, deferred bonds are the bonds on which investor would not receive regular interest, but interest will keep getting deferred and will be paid at the time of maturity in the final payment. So redemption value will be, or the final payment will be the redemption value plus accrued interest or deferred interest. So unlike zero coupon bond, some people can confuse this with zero coupon bond. Now, zero coupon bond is issued at discount. No coupon is given on that. No coupon is, only two things are given, that this is the issue price and this is the redemption value. So redemption is at par and issue is at discount, and that is the amount of discount. But coupon is always zero. So no coupon calculation happens. But effectively, you end up getting return indirectly. Why? Because the discount value and the final money which you receive has inherent interest into it. But as such, no interest is promised. In case of deferred bond, interest will be promised to you. Coupon rate will be defined. So, for example, a company issues a bond with 100 rupees of par value at an issue price of 100 only and promise to you 10% discount. Sorry, 10% coupon on it. That means the company will keep calculating 10% of coupon for next 5 years. But because they are deferred bond, they will not pay that 10 rupees together to you. Every year to you. And those 10 rupees will be paid together for all the next 5 years. The interest will keep getting calculated, and that interest will be paid together with the principal amount at the end of the tenure. So clearly it will be told, see, this is the principal payback, and this is the interest which got due at 10% rate of coupon. Do you guys understand this? And I have an example ready for you.
Yes, so the example would be so
Yeah.
that I can.
So this is the example. This is an example of deferred bond, wherein a company is issuing a bond at 1,000 rupees of par value with a 10% interest rate. Okay. So here you have to invest how much? 1,000 rupees, no discount. You have to invest how much? 1,000 rupees, right? Redemption value will also be 1,000. Redemption value is also 1,000. So company is issuing bonds at 1,000 rupees of issue price, which is also par value, and redemption is also at par, which is the redemption value is also equal to 1,000 rupees. Right? But interest will keep getting accrued, and your final value will not only redemption value, but also the accrued interest which got accrued for the next 5 years. So the first year's interest will be how much? 100 rupees. You will receive interest on how much? 1,000 rupees of
10% of 1,000.
Right? Next year, your closing balance will become how much? 1,100. So you owe, company owe how much to you? 1,100. That is interest 100 and opening. Now next year, the interest will be calculated on how much? Principal plus accrued interest. So principal plus accrued interest will be equal to how much? 1,100. So your interest will be how much? 10% of 1,100. And closing balance will be how much? 1,210. Then third year principal amount will become
1,210.
accrued interest plus principal pending. So that will be 1,210. The interest is 121. Closing balance is 133.
Sorry,
like this. Yeah.
Sorry to interrupt you, Sumit. This is what we used to call Chakravarti. That was a Gujarati terminology.
Interest is always Chakravarti. Practically, there is no simple interest. Interest is always Chakravarti. So if they are holding your money, then they will have to pay interest, not only the initial principal which you have paid, but also the money which they are entitled to pay you, but they haven't paid you. Banks also give you Chakravarti Byaj if they are holding the money. For example, if you deposit your money in a fixed deposit format, wherein you do not withdraw the interest every quarter or every year, the money will getting compounded every year.
Okay.
Right? If you do not withdraw your interest, if you say, no, I will withdraw the interest together with principal at the end of 5 years, then on that interest also you will start receiving interest. See, in real world, there is no simple interest. In real world, there is always Chakravarti or what you call as compounding interest. Simple interest in real world is impossible. If you ever get an opportunity to invest based on simple interest, that is not an opportunity, that is exploitation. Right? So interest calculation will always be like this. In real world, there is no simple interest. There is always a compound interest. Yeah, simple interest is always in books because it becomes easier to understand the concept of interest for people.
Right.
That formula of P into R into T. Right? So that is why that concept is there, but it is only concept, no practicality. Okay. So at the end of the year, total outflow is how much? 1610. So out of this, how much is accrued interest? 610 is accrued interest. 1000 rupees is how much? Yeah.
More than 50% have gotten interest.
No, so you can't say that. You got it rate at 10% per annum. That's what you have to say. Yeah, your money becomes 60% more than what you have invested. But your return is how much? 10% per annum.
Yes.
You calculate return based on annum basis, not on the basis of because that is the most foolish thing to do. Because that is how people fool you. कि इंश्योरेंस वाले आएंगे आपका पास, देखो आप तो सिर्फ 1 लाख रुपए दे रहे हो, आपको हम 50 लाख रुपए देंगे 25 साल के बाद में, अभी तो आप 1 लाख रुपए दे रहे हो, आपको 50 लाख रुपए देंगे. And that is where they fool you. That is the stupidest. So buying an insurance is the stupidest thing in world. Which insurance? Not term insurance. Which insurance? The normal insurance, Jeevan Bima, Jeevan ke saath bhi, Jeevan ke baad bhi, all those stupid policies. That is the most stupidest thing to do in the world, to buy those kind of insurance where you have to keep paying and you wait for. So investment and insurance should never be clubbed, because the return ultimately you get is only 4%. Annualized return. तो इंश्योरेंस कंपनी वाला जब आया आपको बेचने के लिए कि देखो आप 1 लाख दे रहे हो, आपको 5 लाख मिल जाएगा, उसको बोलो मेरे को रिटर्न कितना मिलेगा बॉस. ओके, नेवर लुक लाइक दिस कि मेरा 50% रिटर्न मिल रहा है, ऐसा नहीं. Return you are getting is how much? 10% per annum. Always see return with respect to annum basis. Then only you can actually compare it. Because if you really find out what is the return you are getting in insurance policy, you will find it out. It is only 4%. And then you will start applying your mind. अच्छा 4% per annum पे मिल रहा है. अरे यार 5% तो बैंक देती है FD पे.
Right.
Right. And if you are lucky and invest into mutual fund, 10% मिल जाएगा. Right. And if you are smart, I would not say smart, but if you do direct equity and you have the knowledge and research skills, you may get more than that. Right. So that is why you always look at interest from the perspective of per annum basis, not with respect to that it is becoming 60% more than what you have paid. Right? Never think like that. Okay? So what is the return you are getting? You are getting a 10% per annum return. Total accumulated principal is how much? 100, 110, 121, 133, 146. So what is the total accumulated principal? The total accumulated principal is sum of all these principals which are getting due year on year, right? So this is your accumulated accrued. Accrued means what? It is due, not paid by the company. It is due to be paid. It's how much? 610 rupees. So the company will have to pay you what? The company will have to pay you 1000 rupees of redemption value and 600 rupees of accrued interest. So total, it will pay you how much? 1000 plus 610. That is 1610 at the end of maturity. So proper interest calculation will happen. Proper interest calculation will happen, and that is how you will find out that is what your final payment. Redemption value kya hai? What is the redemption value over here?
1000.
What is the redemption value? 1000 only. But the final payment you will receive is how much?
1610.
1610. In case of zero coupon bond, what is the redemption value?
1000 only.
1000 only. And what is the final value you will receive? Final pay will you receive?
1000 only.
1000 only. So the final pay and redemption value will remain same in case of zero coupon bond, but the final pay and redemption value will be different in case of deferred. Why? Because in zero coupon bond, your return is front loaded. Because in the issue price itself, your return is already there. Whereas in case of deferred payment, there is no front loading of return. Your return is with final payment on. Okay. Is it clear?
Sumit, then in the below formula 149 line number, what in the example, what is accrued interest and deferred interest in this example which we were just now looking at?
So accrued interest is this only. No, accrued interest and deferred interest is same. First of all, this you are deferring the interest. You are not paying. Interest is you are keeping the interest accrued every year. So that becomes deferred interest. Means you are deferring the payment of interest. You are not paying right now. You are going to pay deferring, delaying it. So till the time you are delaying it, it will remain an accrued interest. The moment you paid it, your accrued interest will also become zero. So the interest is becoming accrued interest because you are deferring it. If you stop deferring it, then your accrued interest will also be zero. Right?
Right. Okay. Thank you.
Yeah. So that is why they are same, accrued interest / deferred interest from that context. Yeah. Is it clear, guys? Anyone has any question on this?
Yeah, Sumit, I have one question. Something which I'm not able to understand. So, I remember you mentioned it earlier that the interest or the coupon, like the interest which you receive, is actually calculated on the face value or the par value, right? So,
In case of
in
normal
this
bond.
case, okay, in case of normal bonds. So, in this case,
So your par value is changing now. Matlab the company will have to pay you on par value to fine, but the company will have to also pay you on something which it entitled to pay you, but it didn't pay you.
Okay.
So that will also get due, right? So that becomes the new par value becomes the par value for the first year plus the deferred interest or accrued. That becomes the new par value. Are you getting what I'm saying? So see, otherwise it is not practical, right? See, when I say the interest will be paid on par value, that is true. Here also it is getting paid on par value only, but the par value itself is changing.
Okay. Which is coming down.
Issuance is at par, redemption is at par. So issuance is at 100, redemption is also at 100, and they are deferring the interest. Will you settle by receiving 100 rupees at the time of 5 years redemption? Tell me.
No.
Obviously, will not settle, right? Will say, boss, ये तो फिर आपने 100 लिया, 100 दिया, 5 साल मेरा पैसे का मजा लिया, मेरे को तो कुछ नहीं मिला. Huh? So obviously, you would seek the revenge, right?
Yeah.
Because if you are delaying it, then you have to change the par value every year. The par value remains 1,000 only, but for calculation purpose, I'm saying you have to think it like that. That the par value is shifting.
Yes.
Right.
Got your point. Okay.
Right. Yeah. Any more questions, guys? Anyone has any more question, guys? Yeah. No, then we can take a quick break of 10-12 minutes and come back. Yeah.
Sure.
Okay.
Thank you.
Yeah. Thank you, guys. We'll take a break. We'll come back in 10-12 minutes and we'll start.
Sure.
All right, guys, are you back?
Yes, sir.
Yes, sir.
Okay. Just give us- I'll just put on my earphones. Yeah, can you hear me?
Yes.
All right. So next is inflation index bond. As the name suggests, they provide you some edge over inflation, right? So inflation is a big problem India is grappling with. We talked about not only India, Madhu. India, the effect is not that prominent, but in in the Western countries, inflation rate has gone up as high as 13% or 12%, right? So when you are investing into bonds, the tenures are generally very high. Like it would be as low as 5 years to as high as 15 years or 20 years. Now, putting your money for that long or committing that money for that long period of time has a huge interest rate risk. Can anybody tell me how? How putting money for that long tenure can have interest rate risk for investors?
There might be the changes in the interest rate due to the inflation.
There might be for a period of 15 years, there will be change in interest.
Yes.
Might need. If you see the history of last India's 15 years, interest rate would have changed every 3 months. Interest rate would have changed every
3 months.
3 months. Yesterday only interest rate meeting was there, right? RBI had a meeting, MPC meeting yesterday itself, right? Actually, there is a background noise coming from your side, so I'm putting you on mute. You can unmute whenever you want to speak. But yesterday only there was an MPC meeting, right? Where RBI governor had increased the repo rate by 50 basis points. Somebody tracking the market would be knowing that, right? So interest rate keeps on changing every 3 months or 6 months, right? And might nahi, there will always be. So what is the interest rate risk is interest rate can go down or up, and that is the risk which investor is facing. For example, if you have committed 1 lakh rupees at an interest rate of 6% to a company, next year interest rate become 8%. Will company start giving you 8%? Tell me. Will company start giving you 8%? Tell me. In a normal bond. No, they will still be giving you 6%. And then will come in picture who? Then will come in picture who, Ayushi? Then will come in picture your friends and your family. क्या बेवकूफ है 6% पे पैसा दे दिया पता है अगर अभी देता तो 8% इंटरेस्ट है and then you will have sleepless nights. Yes or no? Yes or no? Right?
Yes.
So, and even without having this social pressure itself, there is a huge problem, right? Why would you would be suffering internally a lot, because every month you will receive an interest which is much lower than what you can get in market. And that is the risk an investor is facing when they invest into bond. So to attract those investors who generally do not like to invest into bond because of a fixed interest rate or coupon rate problem, companies or government sometimes issue something called as inflation index bonds or flexi cap bond. You can call them inflation index bond, the right one. So inflation index bond means that inflation will get adjusted into the principal value. Coupon rate will be adjusted in the principal value. Coupon rate which you would receive will be received on the adjusted principal value. So the principal value or the issue price which you have paid will adjusted with respect to inflation, and you will get interest on the adjusted value, not on your par value. Mr. Raj, that is something again different from general statement of mine that you generally receive coupon rate on your par value, right?
Yeah.
Here, your par value will get adjusted. Here, your par value will get adjusted by inflation, right?
Okay.
And interest will be calculated on that adjusted value.
Adjusted value. Okay. Yeah.
Right.
Got it.
So, for example, and if you see the example underneath over here, you will have to go on mute when you're not speaking because background voice are pictures. So, for example, company issues a bond at 1,000 rupees issue price. Inflation that year is 3%. Coupon rate is 3%. The coupon rate of 3% will not be calculated on issue price of 1,000 rupees. It will be calculated on adjusted post-inflation price, that is 1,030. If inflation is 3%, your adjusted principal will be equal to 1,000 into 1 plus 3%. And if coupon rate promised to you is 3%, then you will receive a coupon of 30.9, which is calculated on 1,030, that is adjusted principal, not on the issue price of 1,000. Generally, you receive 3% of par value, right? For example, issue price and par value is same, that is 1,000. You receive 3% coupon on par value, that is 30 rupees only. But you are receiving a coupon rate not on issue price, you are receiving on adjusted principal, that is post adjusting the inflation. The principal is 1,030. So you are receiving a coupon of 3% on adjusted value. So that is why you are receiving not 30, but you are receiving 30.9, right? Yeah. Next year and every year, this principal will be adjusted. Every year, this principal will be adjusted. So next year, if inflation is 6%, then your principal will be last year's adjusted principal into 1 plus this year's inflation. So adjusted principal will be 1,091. Your coupon rate being 3%, you will receive this coupon not on 1,000, not on last year's adjusted principal, but this year's adjusted principal, that is 1,091 into 3% coupon rate. So you will not receive 30, which you receive in a normal bond, or you will not receive 30.9, which you received last year, but you will receive 32.72754. So your returns are inflation adjusted, right?
Got it.
You can see with the interest, with the increase in the inflation, your coupon or return is also increasing. So this year your return has increased from 30.9 to 32.754. So your increase in inflation, if you see, so increase in return will be same as the inflation rate. Right? So your coupon has increased by how much percentage? 6%. And your inflation rate was how much? 6%. So you are getting inflation adjusted return. Right?
Well, yeah.
Next year, if the inflation is 2%, your principal will further get adjusted upward 2%, and your coupon will be calculated on the adjusted principal for that. And that's how you will be paid the coupon. Right? So these are called as inflation index bond. Called as inflation index bond.
Index bond.
Right. Okay. Anyone has any confusion, question? No. Then let's understand the concept of. Just give me a second. I have to explain you the concept of dirty price. Just see if dirty price is single. Yeah, here is the concept of dirty price. We'll talk about it. Okay, before coming to dirty price, let's do this. Year to maturity. Concept of year to maturity, YTM. Coupon will be reinvested at the same rate of year to maturity. Yield to maturity, sorry. Yield to maturity, YTM, yield to maturity is coupon will be reinvested at the same rate of YTM, that is yield to maturity. So what does it mean? So what it basically means is the return which an investor receive by, by holding the bond till maturity with respect to interest payments as well as principal repayment. The return which is investor can anticipate to make through bond with respect to current market price of the bond. So do you guys, anyone understand what is IRR? To explain this, let me take the help of IRR. Do you understand, anyone
No.
understand IRR?
No.
So IRR is called as internal rate of return. An internal rate of return of a security will remain equal to the coupon rate of that security if that security remains with you till the end. Are you getting what I'm saying? The internal rate of return of the security will remain equal to the coupon rate which is offered on that security if you hold that security till the end.
Okay.
And if issue price is same as redemption value. If redemption value is different from issue price, then your IRR will be different. But if issue price and IRR is same, sorry, issue price and redemption value is same, then your IRR will be equal to the coupon rate if you hold that security for till maturity.
Okay.
And it will change if you sell in between. Before maturity, if you sell, then it will change. So again, let me read it. Total rate of return an investor can anticipate. Total rate of return an investor can anticipate. Shashank, I'm putting you on mute. You want to say something? You unmute and say. But do not remain unmuted because there's a background noise coming from your side. You want to say something?
No, it must have happened by mistake. Sorry.
Okay. Okay. So total rate of return an investor can anticipate to make through bond with respect to current market price. That is what yield to maturity. Now, when you calculate yield to maturity before maturity, when you calculate yield to maturity before maturity, then that's the definition which it is. Total rate of return an investor can anticipate to make through bond with respect to current market price of the bond. So when you have the plan to not hold it till maturity and you have to calculate the YTM, then that would be equal to comparing the bond with respect to current market price of the bond. Can current market price of the bond be different from the issue price of the bond? Can current market price of the bond different from issue price of the bond?
Yes.
Yes.
Right?
Yes.
It can be different, right? With respect to market rate, the market price changes, right? So you're comparing the current market price to calculate YTM. So the formula is, and you will not be asked, this concept is much bigger than what is required as a part of this course. So just look at this formula very casually. You do not have to be remembering this because it is much bigger concept. Just we need to know just a bit of it. So the formula to calculate YTM is coupon payment plus face value minus market price of bond divided by years to maturity. This whole numerator divided by the average of face value and market price of bond. So yield to maturity is equal to, again, coupon payment, and you have to remember this formula, coupon payment plus face value minus market price. P stands for market price. So C plus F minus P divided by N. C stands for coupon payment. F stands for face value. P stands for market price of bond divided by number of years to maturity. This whole equation divided by, so this entire thing will be in the numerator, which would further be divided by in the denominator, it would be average of face value and market price of the bond. So let's do it. Coupon payment, for example, on any security, coupon payment is 10%, and the face value is 100. So 10 is the percentage is coupon value. Face value is 100. Market price of bond is, for example, 90 rupees, and years to maturity is 3 years. So how would you calculate it? Yield to maturity. 10 rupees, right? 10% of 100 is coupon. That is 10 rupees plus face value is 100 minus market price is 90 divided by maturity is 3, right? That would be numerator, and the denominator will be average of face value and market price. So what is your yield to maturity? 80 divided by 95. That is how we calculate the yield to maturity, basically. So here we need to just keep, okay, we have not kept the bracket correctly. So this is 100 minus 90. This is 1. And then this is again divided by 3. This is 1. So what is your yield to maturity? 14%. Now what does it tell us? What does it tell us? It tells us very simple, and try to understand it. It is a concept of IRR. It tells you that today if you buy it at this current composition, what is the current composition if you buy it? You are getting a coupon, a bond. What would be your investment value? Your investment value will be what? Market price, right? Today if you have to buy it, yes or no? Today, from the secondary market, if you have to buy it, will you buy it at 100 rupees or 90 rupees? Tell me.
90 rupees.
90 rupees.
Market price. So if today, if you have to buy this bond, you will pay how much? 90 rupees on, and you will receive coupon for how many years? 3 years. At what rate? 10%, right? On what value? On face value. Your ultimate return will be equal to how much? 14%. But the condition is you will have to hold this security for how many years?
3
years.
3 years.
3 years. So this is a quick calculation of YTM. Can we do it other ways? Let's look at it. See, first year you will receive a coupon of how much? 10, right? Second year you will receive coupon of how much? 10. Third year you receive two things. What all those two things will be? Your coupon of 10 rupees plus redemption value. That would be face value at par 100. So in total you will be receiving how much? 10 rupees and 110 rupees, right? Yes or no?
Yeah.
Yes or no? Hello? In 3 years, in the year 1 you will receive 10, 2 will receive 3, and third year you will receive 110. But to receive all of this, what is your exact investment?
90.
90 rupees. What is your exact investment is? 90 rupees. Yes or no?
Market price.
Yeah.
Yes. So what is the inherent return you are getting? What is the inherent return you are getting in this? Can anybody tell me?
10%.
140.
How 10%? How 10%? See, in order to find out the market value of this stock is how much, this particular bond is how much? 90 rupees, right? And you are getting 10 rupees in the first year, second year you're getting 10 rupees, third year getting 110 rupees back. So by investing 90, you are receiving total how much? 130 rupees, right? But what is your per annum return? That is what is calculated by this formula. That your per return is how much? 14%. What is the per year return? Realized return? 14%. That is an approximate value of your return if you get invested into this stock. Sorry, this
bond.
That's what this YTM calculates in a approximate manner. That if you hold this, then that is the return you are getting. That is a rough calculation. Because otherwise, if you start calculating it annually, you are getting different return every year. First year, you are getting return equal to how much? 10 divided by 90, right? So your first year return is how much? 11%. Your second year return is again 10 divided by 90. So your second year return is how much? 11%. Third year return is how much? 110 divided by 90. The third return is how much? Third year return is how much? How much?
2%.
22%. So every year's return as such is different. So what is that one return which signifies an compounded annual growth rate? We can also call it compounded annual growth rate in this investment. That is something which you can approximately calculate by the formula C plus F minus P. And now let me update this formula. C plus F minus P divided by N. C plus F minus P divided by N. So F minus P needs to be together in one bracket. Here then the whole equation divided by F plus P divided by T. 2. So that is the return you are getting. 14% return you are getting approximately in this. Because otherwise, if you start calculating per annum return, it is different. 11%, 11%. See, I don't want to get too much into this because then it will you would have to understand the concept of valuation of bond, which is not as a part of this course. If you have to find out what is that one rate you are getting, you have to go through the concept of discount rate method. So basically what you do is 90 should be equal to 10 divided by 1 plus x, 10 divided by 1 plus x, 1 plus x to the power 2, because you are getting return for 2 years over here. So 1 plus x to the power, you have to discount it by x by power 2, and 110 divided by 1 plus x to the power 3. That is the formation of. So 90 should be equal to 10 divided by 1 plus x, 10 divided by 1 plus x to the power 2, and 110 divided by 1 plus x to the power 3. So what is the value of x? That is you have to calculate. So this is the equation. It would come approximately equal to 13 to 14%. So rather than going with an, because you have to go with a concept over here, you can't do it with a pen and paper also without assuming numbers. So you'll have to solve this equation multiple times to assume that number. Or you can apply a direct formula in Excel with the formula which you call as IRR. So here 90 is what? Cash outflow. Yes or no? 90 you have to pay to receive 10, 10, 110, right? So because 90 is a cash outflow, you have to represent 90 as minus 9. And then if you apply the formula of IRR, because in IRR, one cash outflow and cash inflow both has to be calculated. Solve it. Is it coming 14%? Tell me. Yes or no? Hello?
Yes.
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 This is coming 14%. How is Excel solving it? You know, Excel is solving it by assuming multiple values of x and finally reaching to one value of x. Because this equation cannot be solved. This equation cannot be solved. This equation cannot be solved without assuming multiple values of x. Are you getting what I'm saying? We have to start with assuming one value of x if you are doing it on pen or paper. So you first will assume, for example, 10%. You will get a value which will not be equal to 90. So for example, I assume x the value 10%. So, and I solve this equation. So how would I solve this equation? 10 divided by 1 plus 10%, right? Second will be 10 divided by 1 plus 10% to the power 2. And third will be 10 divided by 1 plus 10% to the power 3, right? Assuming x is equal to what? 10%. So if you solve this equation, this is 110, right? Last year it is 110, right? This should be in bracket. Yeah. So if you solve this equation, you get a value equal to how much? 9.1 plus 8.26 plus 82.664. What is the value you are getting? What is the value you are getting?
100.
Are you getting 190? The value we should get is equal to how much? 90. So those who are getting confused, for example, Neha, let me pick you. You're getting confused, right? What
Yes.
we are trying to do is, see, there are different numbers you are receiving. There are different cash flows you are receiving every year, right?
Right.
You are paying 90 rupees. Look at practically. You are paying how much?
90.
90 rupees. So 90 is going out. Then the first year you are receiving 10 rupees. Second year you are receiving 10 rupees. Third year you are receiving 110 rupees, right? So ultimately it's a game of cash flow. It's a game of what? Cash flow. 90 has gone out. 10 has come in the first year. Second year it has come 10. Third year it has come 110. And there is a concept of time value of money. What is the concept?
Time value of money.
Time value of money. Based on that concept, can we calculate one rate which is inherently we are getting? We are getting multiple rates. We calculated. I calculated it for you, right? 10, 11, 11 and 22%, right? But that is not true. What is that one rate we are getting at the end of 3 years? What is that one rate we have got? We can say, I have put that money and I have received how much? This much. What is that one rate, right? We applied a simple concept of 72 point divided by number of years, right? But that concept can only be used when your money is getting doubled. Then you can calculate a rate. Here your money is not getting doubled, right? Here your money is not getting doubled, and there is no fixed time period after which you are paying and after which you are receiving. Every year there is some cash you are receiving, right? So that 72 divided by 5 will not work everywhere, right? So here we are trying to find out what is that one rate you have got at the end of the 3 years, which you can say, yes, I invested 90 and I have got these 3 cash flows out of it, giving me that one rate of annualized return. That is rate we are trying to calculate. So that if that is one rate we have to calculate, we have to assume that is X, right? For all 3 years. Right. First year, it is now the concept of time value of money. This 10 is divided by 1 plus X. Why? Because first year it is getting discounted by 1 year, right?
Yeah. Right.
Second year it is getting discounted by 2 years. So we are dividing 10 divided by 1 plus X to the power 2. Because these are 2 years of discount rate is calculated. And third is 1 plus X to the power 3. Because this cash flow you are going to receive after 3 years. So it needs to be discounted for 3 years. So to the power 3. Now we don't know what is X. So if you have to do it manually, we have to assume a rate you have to start with. So we assume that rate is 10%. So when we assume rate is 10%, what is the value we are getting for the equation at the right hand side? We are getting a value of 100. But the value we should get should be equal to how much? The value we should get should be equal to 90, right? In order to match this equation, LHS equal to RHS karna hai, to mujhe 90, I have to get 90, right?
Right.
So if I had to get it 90, would I have to increase the discount rate or decrease the discount rate? The rate which I have assumed is 10%. Should I increase from here or should I decrease from here? If rate is in denominator, if I increase it, then the value will decrease. That is 100 will decrease. If I decrease this rate, because it is denominator, if I decrease the rate, the value I will get will be higher than 100. Yes or no?
Yes.
Because X is in denominator, right? Pure mathematics.
Yes.
Right? So I have to increase the rate to get a lower value. I want to go from 100 to 90. That means I will have to increase the value. But by what percentage, I don't know. By what percentage, I don't know, right? Again, it's a guesswork. So, but you know, it should be more than 10%. You got a benchmark,
Yes,
there is
yes.
10%, you need to know. So then next time we can assume, for example, 12%. What we are assuming now? 12%. Okay. So if we assume 12%, so we divide everything by 12%. So if you divide it by 12%, what is the value you are getting?
95.2.
That means the value should further fall. We still haven't received to 90.
90.
Right? Value should further fall. So the same guesswork we have to do further, but we get an idea. Every guesswork we are doing, we are getting an idea. What idea we got? That we have to increase the rate further by higher than 12%. The rate has to be higher than 12%. That's an idea you got. So for example, this time you assume the rate to be 15%, right? 15%. So see, so you assume you got an idea that it should be more than this, so you assume a rate of 15%. So manually, can you see how cumbersome it is? You are getting a value which is lower than 90.
Yes.
Right? That means the rate cannot be as high as 15%. So now I get a range. The value is higher than 12%, but has to be lower than 15%. I got a range, right?
Yes.
Again, I can assume 12.5, 13 or 13.5 or 14 or 14.5. These are three things we can assume, 4-5 things we can assume. We lucky and we get 14%. We assume how much? 14%. And we assume 14%, and this time maybe we get the value. This is the work this Excel is doing when you are applying the formula of IRR, right? It's entire work. We're getting 90, very close to 90, right?
Very close to 90.
So that means this 14% is the IRR we are getting. Again, it is not 14%. If you will see, this is not exact value is 14.33113, something like that. So your IRR formula will give you the best rate. Exactly, you can just think of it, how many iterations we have to do to reach to this rate if we are doing a guesswork. Many, right?
Yes.
So this entire work is done by Excel by applying formula IRR when you have to arrange the values in time value wise. First time you are getting how much? 10. Second time you are getting how much? 10. Third time you are getting how much? 110. And at the time of 0, that means at the time of investment, that is right now, you have to pay how much? 90. Now, what is cash inflow and what is cash outflow? Just identify that. Cash inflow is how much? 10, 10, 10. Keep it positive. Cash outflow is what? Negative. How much? 90. So keep it 90 and equal it. You will get IRR ka formula. You get the exact rate you are getting out of it. This work can be done manually by not doing guesswork, or because it is very time taking, but without doing guesswork, but an approximate value you will get very close to a correct value, but approximate value by doing a simple thing. What? By applying a formula which is this.
Right.
C plus F minus P divided by N whole value divided by F plus P divided by, right? We did the same thing. Did we get approximate value of 14% or not?
Yes.
Numerator में यही किया था. 10 plus 100 minus 90 divided by 3. Why? Because 10 is coupon, that is 10% of 100 plus 100 by minus 90 is nothing but face value minus 90 market price divided by number of years to maturity, that is 3 years, divided by average of face value plus market price divided by. So if at the current value, if you buy it and hold it till maturity, the YTM you will receive is 14%. That is, if you plan to hold something at maturity, buying something at market value, YTM is something which you can expect to get as a return. Have you understood the concept of YTM now?
Yes.
Much more than this, it is bigger than much more than this, but you do not need to know get it. In fact, other trainers would have only told you this formula. I just explained you how this formula has come into existence. Okay.
Okay. Thank you.
Yeah. So this is actually, there's an entire concept of time value of money on which it is built. But what you can say is, if we start calculating return year wise, it would be a different value and not be correct value. At the end of the 3 years, if you have to look back, if you have to come circle back to one rate which you have got, out of this 3 years of investment of 90 rupees, what is that return you have got? That return is nothing but YT. Yeah. Anybody has any confusion? And we can also call or refer to this concept, those who are chartered accountants or who's ever done chartered accountancy or courses in finance, they know the concept of time value of money, and they would be knowing the concept of IRR. Because IRR is a very important concept in capital budgeting. So those who are from core finance background, I'm just saying this for them. But that is what the rate, you can say, or you can say I have got 14%. 40.339. Is it clear, guys? Is this clear?
Yes.
Mr. Raj. Yeah. Mr. Raj, is it clear? Is this concept clear? The return which you can expect, to get by staying through the course of maturity, by investing in some security at current market price. Right?
Yes.
But for example, Aditya, if you would not have invested in the market price, but you would have invested at the time of the issuance itself. At the time of when? At the time of the issuance itself. Then the price you would have to pay is what? Face value. Then for you, the market value of bond is equal to the face value of bond, right? Because
Yes,
at the time of issuance, the market value and face value will be same, because issuance ke time pe coupon rate and interest rate, market rate going on will be same, right? Then you will notice
yes, sir.
the yield to maturity. The yield to maturity is different, right? And then
Yes,
in
sir.
that case, okay. So this generally YTM as a formula you see, Aditya, only when you are purchasing things from market. Okay, not directly from
Yes,
the
sir.
issuer. Okay. Any confusion on this, guys? I mean, any confusion there?
No.
So guys, okay. One thing. So there is some error. So I have not linked this, right? So for example, let me link it. This 10% you have calculated how? This 10 rupees you have calculated how? 10% of face value, right? That is how you get 10 rupees, yes or no?
Yes.
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 Because if you are buying at a price which is equal to the market price, at the face value and the market price are same, the yield to maturity will be equal to coupon payment. That is what I said earlier, right? It was not coming like that. I just got, because it was not linked. So let me link it. So 100, face value is 100. And 90 is your market value, right? Divide by tenure. Tenure is your years to maturity. Right now it is same, right? You are getting what? When you are getting at a market price of 90, what is your yield to maturity? 14%. But Aditya, what I was telling you, if you buy this from the issuer itself, right? Not from the market. At the time when coupon rate and market rate is same, at that point in time, your market price or your purchase price of the bond will not be market price, but will be equal to face value only, because market value itself will be the face value only, right? At that point in time, as soon as I press enter, you will find the YTM will be equal to coupon payment.
Yes, sir.
Right? Because see here, whichever way you calculate, even in case of IRR also, because then your outflow, cash outflow will be not 90, it will be 100, right? See, your IRR is coming 10% or not, right? Similarly, here also, this is the case of the first assumption. You assumed a rate of how much? X is equal to how much? 10%. Then your value came as 100 or not? which is equal to your purchase price. Yes or no?
Yes.
The equation is getting, in first case itself, you are getting correct. So your coupon rate will be equal to YTM when you are holding the security till maturity by purchasing it from issuer itself. Does it make sense?
Yes, sir.
But if you are buying it in from market after the issuance of securities, maybe 2 years, 3 years after the issuance of the securities from the market, then the market price will be different based on the what is the current market rate going on in the
Interest
market,
rate.
right?
Yes, sir.
What is the current rate? Obviously, if you are getting something of 100, if somebody is selling it 90, that means what? Market rate in the current scenario would be higher than 10%. Yes,
Yes,
or no?
sir.
That
Yes,
is why
sir,
somebody is
higher.
selling at a 90 rupees. And are you getting
Yes.
higher or not? Are you getting higher or not?
Yes.
Are you getting higher or not?
No, sir, no.
You are getting higher now, 40%.
YTM. If
I'm getting
YTM is
40%.
higher, but the coupon is same. My interest rate, I'll get the same.
Coupon is same, but your realized
Return is
return will
higher.
be equal
Yes,
to.
sir. Yes, sir. It's higher. It's higher. It's higher.
It is higher. It will
14%.
always be. It will mostly be equal to what? It would be mostly. So if you have to calculate what is market rate, you can assume 14% is the market rate going on in the market currently.
Yes, sir. Yes, sir. Yes.
That is why somebody is ready to sell something of 100, which he bought in 100, ready to sell in 90. Why?
At 90.
Because the market rate would have got up than the coupon rate. So yield to maturity would largely be equal to market rate.
Yes,
Approximately be equal to market rate. Now, can you do the back calculation and think of how this market price are decided? Think about
Yes,
it.
sir, we
For
can
example, you don't know. Simply see, if you don't know the market price, okay, you know what? The YTM. If I give you the YTM, if I
Yes,
give
sir,
you
we
the
can back
YTM,
calculate it.
we can back
We can
calculate,
back
right?
calculate it. Yes.
Just in this equation, you make X is equal 90 ko you make X and X ko you make 14%. Immediately you will get a value which is equal to 90. Yes or no?
Yes, sir.
And that is how the market price of the bonds are calculated by market effective.
Yes.
For something which has a maturity of more than 1 year.
Yes.
Right? When market rates are different than the coupon rate. Now it does it give more clarity to you? Though it all discussion was not required, but it's important that you understand it's the code.
Yes, understood, sir. That's clear.
So 3 takeaways. YTM will be equal to coupon rate if you buy at the time of issuance and hold it till maturity. YTM will be different from the coupon rate if you buy the security in the secondary market, which had issued maybe earlier 2 years, 3 years back, but trading in the security market at a market price, which is lower or higher than the face value. YTM will be different from the coupon, right? And third takeaway, if you know the YTM, you can calculate the market price, because YTM at an approximate will be equal to the market rate. Yes or no? So in the secondary market, at what price the security needs to be traded can be calculated by using the concept of YTM or market rate, right? So YTM by that logic should be largely equal to market rate if market is efficient. Yes or no?
Yes, sir.
And if there is an inefficiency, then there is a quick money to make. If there is an inefficiency, there is a quick money to make. And that is why traders in the bond market also can make money in short term. If they find out that YTM of a security is different than the market rate. Are you getting what I'm saying? Price will adjust with respect to the demand and supply of the securities. That is all on YTM. I hope you understand. If you want to understand it in detail, try to listen to this video again and again. You will understand what I'm talking about. But so far, anybody has any question on it? Anybody has any question on it? Tell me. Come on, quickly. Come on, guys. Come on. Tell me. Beautiful concept. How the prices are fixed in the market and how traders can make short-term benefit. If the market rate is not equal to YTM, it gives an advantage for arbitrageurs to make money. And that would influence the trading demand and supply for the securities accordingly. Right? Louis, any question? Come on, tell me.
No questions. But it's a little heavy for everybody to digest, including me.
But you understood it, like you feel it, you understand it, right?
Yeah. But it'll need some practice.
Yeah, just go through this video again. will make you clarity. Okay. Mr. Gehlot, you have any question on it?
No, sir.
So to take away Lewis, your market rate should be equal to your YTM. That means price to perfection. If market rate and YTMs are equal, that means market price is the best, is perfect. But if YTM in any security is lower or higher than the market rate, that gives an opportunity for short-term trading because the price is not perfect. So demand and supply would accordingly get updated, and it will impact your market price till the time your market rate and YTM become same. Market price will keep getting adjusted. What I mean to say is market price will keep getting adjusted till the time your YTM and market rate gets to same level. Right. Yeah.
Got it.
Okay. Yeah. All right. Now let's understand the concept of dirty price. So there is this concept of clean price and dirty price. This concept occurs in the secondary market again, only in secondary market, like the YTM concept generally occurs in case of secondary market transaction. Dirty price and clean price also occurs in case of secondary market. When you are buying any stock, when you are buying any bond, and we know on bonds, coupon rates are also due, right? So when you buy a bond at the market price, the actual payment you have to pay is not only the market price, but also the accrued interest which is due on that. Think about it. For example, you have bought a bond, a par value of 1,000, which is issued at 1,000, so issued at par, right? Where coupon rate is 10%, which is to be paid semi-annually. The date of purchase is what? The date of purchase is what? 1st January. The date of purchase is what? The date of issue on purchase is what?
1st Jan.
1st January.
1st Jan.
So when is the first coupon will get due? If coupon needs to be paid semi-annually at the rate of 10% per annum. When is the first coupon will get due?
June.
After 6 months.
June.
After 6 months, that is 30th June, right? Not 1st June, but 30th June, yes or no? January, February, March, April, May, June, all 6 months needs to be calculated, right? So the first date or due date of coupon payment will be either 30th June or 1st July, right? And what is the amount?
Okay.
What is the amount? Coupon amount, my dear friend. What is the amount you will receive? Coupon. 100 is
50.
annual, 10% rate is, again, you did the same mistake. I told you guys, right? This is the mistake everyone does, right? The coupon needs to be paid semi-annually, right? So the coupon which will get due annually is 100 rupees. But for the half year period, the coupon rate, if it is 10% annually, that means it is 5% half yearly. So the coupon payment will get due is 50 rupees. That is 5% of 1, right?
Yeah.
So far is things clear?
Yes.
Yes, sir.
Now, if for example, the transaction happens on 30th May in the stock market, bond market, which date?
30th May.
30th May. And the market price at which these bonds are getting traded is 970. What is the market price?
970.
970. The question is, will you sell these bonds for 970? If you have to sell, will you sell on 30th May these bonds to someone at 970, that is market price on? Huh? Think about it.
No,
Why not?
because
I have not
there
even
is
got my.
an interest accrued of around 5 months till 5 months from.
If you would have hold this stocks, this bonds one. So I'm sorry, so I'm a stock market guy, so I keep on saying stock. Please pardon me for that. I'm a lover of stock. I have huge love. After my family, the next love is stock market. So I'm very sorry for that. Again, I'm saying stock. But bond. In the bond market, if you would have held this bond one more month, you would have entitled to receive how much?
1050.
How much? 50. Think about a situation where you and your friend, decide to take a house on rent. Okay. And for 6 months. The landlord charges you 1,000 per month. So what would be the total rent?
10,000. Total 6 months, 6,000.
6,000. Now you and your friend say, see, we both have to go to Bangalore. I will go for the first 5 months. You go for the last 1 month. And we do not have to do this hassle where we have to take no. So she's a good friend to you, okay? So you have to go to Bangalore from January to May, and then she will have to stay in Bangalore for the month of June. So the total rent to be paid is how much? 6,000. And you enter into a commitment with your friend. Why not you come and stay in the same house? I anyways will be leaving the house and vacating the house. So the month which you have to stay in Bangalore, you can easily stay in my house, right? So tell me, the landlord will receive 6,000, that is fine. But how much should be paid by you and how much should be paid by your friend?
Okay, because I stayed for 5 months, only 5,000.
And your friend?
But for my friend, if she stays for 6 months, 6,000.
But she's staying only for 1 month, right? For this last month, she's coming to Bangalore and staying.
But she's not leaving the place, like current place.
No, so try to understand. Both of you live in this place of Lord Shiva, right? What is that located in?
Somnath.
Somnath. Yeah,
Somnath.
Somnath. Both of you live in Somnath. You got an opportunity to work in Bangalore for the month of January to May. Your friend got an opportunity to work for the month of only June.
Only
Okay?
June. Okay.
So you are saying कि यार तेरे को जून में आना है ना, तो उसी फ्लैट में आ जाना, मैं शादी करूंगी तो उसी फ्लैट में रह जाना.
हाँ.
ठीक है, मैं इस फ्लैट को while entering into a contract with the landlord, I will not take the flat on rent for 5 months. What I'll do is I will extend the contract for 6 months. Right? So for the first 5 months, I will stay. For 6 months, you come and you stay. I will anyways come back. Right? Tell me, how much rent you will pay and how much rent your friend will pay?
I'll pay 5,000 and my friend will not pay anything because she's staying with me, right? And she's my friend.
She was coming back to Somnath. Try to understand. You are coming back to Somnath. She is going. So you are staying in that flat only for the month of January to May. Again, I'm repeating. And for the month of June, only she is staying over there.
She'll have to give them 1,000. Sorry, I am taking longer
Simple,
to
right?
respond.
Yeah, but now it's simple, right? And let's not assume that your friend is my friend.
I'm just, I was thinking what is.
Keeping that personal equation outside, practically. How much should you pay? 5,000. How much your friend should pay?
1,000.
Right. Now, for example, your friend has paid on your behalf. Here, मैं RTGS कर देती हूँ. Landlord has asked for 6 month rent in advance. Your friend says, okay, you are doing so much for me, you are finalizing the flat, you are making all these extra efforts. So let me make the payment. I have online banking. You don't have an online banking. So she has made the 6,000 total payment to your landlord. Tell me now, does it mean that you do not have to pay 5,000?
No, I should pay 4,000.
And whom do you pay?
My friend.
To your friend, right? So just because your friend paid on your behalf, that doesn't mean that you do not have to pay back to your friend.
Makes sense. Yes.
Makes sense.
Yes.
Now the story is, rather than paying, it is on the receiving side. Similarly, if your friend would have received on your behalf 6,000 rupees, on which you are entitled for 5/6 of the value, and she is only entitled to 1/6 of the value, don't you think your friend should pay you back 5,000?
Yes.
If she has received on your behalf.
Yes.
ठीक है, अब आते हैं वापस इस situation. Let's come back to this situation. Having this in your background. Here is a situation where you bought it from the company. The company issued to whom? To you. At what price? Issue price of 1,000. On which you would receive how much? 50 rupees. After how many days? After 6 months.
Yes. Right?
But company will pay this to the holder of the security on that due date. Simple. Company will not go into all this. On that day, whosoever is the legal owner of that security, they will end up receiving the interest. Makes sense? Right? Yes. Company will not do transaction. Okay? So now, but because you are selling it on 30th May to, for example, Louis, right? So who will be the owner of the securities on 30th June?
Louis.
So company will be paying this 50 rupees to whom? To you or to Louis?
Louis.
But don't you think it becomes responsibility of Louis to pay you 5/6, 80%, whatever to you, because for out of the 6 months, for 5 months only you held the security.
Yeah.
Think about it, right? And do you think it will make any sense that Louis will pay you after receiving it from the company? Or rather, you should adjust that when you are selling to Louis itself in the sell price, because you cannot trust, because Louis live in different world, you live in different world.
Right.
In this equation, Louis is not your friend, right? He's just a market participant. So don't you think, rather than entering into another contract where you make Louis that, hey Louis, you pay me the market price of the bond, and let's enter into one more contract where after 1 month you will pay me whatever you amount you will receive 5/6 time of that, right? There's no point of entering into this contract, because who knows, you sell in the next 3 days itself, and there's new one. So this circle will never end, right? It will keep revolving. So it's better why not you price it in today itself. That here use the market price is 970, plus this securities would receive 50 rupees. The holder of the securities will receive 50 rupees for 6 months. But because I hold the securities for 5 months, so I'm entitled to receive 5 months of interest. Right?
Yeah.
So that 5 months of interest for 6 months, if it is 50 rupees, for 5 months it is less than 50 rupees. For example, 40 rupees. For example, we'll calculate we'll see how to calculate that. But 40 rupees. So 970 is the market price plus 40 rupees. That is the price I'm going to sell it to you. Or you wait for 1 month, because after 1 month I will be ready to sell it at market price, because by that time 50 rupees I would anyways become receiving back from the company itself. Right? So that is called as dirty price. Clean price is market price. The stocks which are trading, the bonds which are trading at the market price is the clean price. Okay. What is the dirty price? Dirty price is a clean price plus whatever interest due as of that day of trade, which is not received or which is not paid by the company yet.
Yes.
So you take it from the new buyer itself, because ultimately the new buyer will end up receiving it from the company. right?
Yes.
But you were entitled because you held those securities for 21, so you are entitled to receiving, right?
Yes.
So dirty price. So transaction should happen at what price? Clean price or dirty price? Dirty price.
Yes.
Right. Now, there are some markets at which transaction happens. The market price itself is dirty price, and there are some markets where market prices are clean. So if you are trading in a market where it is a clean price market, then you have to calculate the accrued interest separately, and you have to add it to the clean price, and that is the price you will quote at which transaction will happen, right? And if you are trading in a market where the trades happen itself at dirty price only, that means market itself quotes that price, which is dirty price. Means market itself calculates the value of interest, right? The accrued value of that interest. Then the transaction will happen at market price itself, right? For example, I forget which market. Out of one, US and UK, one market is trades at clean price, and one market trades at dirty price. So the market which trades at dirty price, you do not have to do a separate calculation of accrued interest and all. That market price of that, which is dirty price, at which you close the transaction. But if you are trading in one of the market that is UK, Europe, where it is clean price market, then you have to separately calculate the accrued interest value, add it to clean market value, that is clean price, and at that price, that is the price you will quote for buyer of the security, right?
Right.
Now, how this accrued interest will be calculated will depend on the convention, and we have talked about this convention. There can be 4 types of convention: actual days by 360, actual days by 365, 30 by 360, or actual by actual. Okay. If you remember, we have talked calculated this while looking for quarterly, annually, multiple payment methods of interest, right?
Yes.
So whichever method you follow one method. You have to be consistently follow which method. For example, if you follow actual days by 360, in this example, you are entitled to receive an accrued interest of how much? 41 by 338, which is nothing but 10% of 1000 into how many days? 149 days. Actual days कितने होंगे? नहीं. Actual days कितने होंगे? See, you can calculate actual days by this formula. Basically, the difference between 30th May and 1st Jan. How many days are there?
Okay, 149
days. 149. So actual days between these two dates are how many days? 149 days. So 149 days divided by 360. What is the value you should receive? 41. Actual days by 365, you will receive the value 40.82. 330 divided by 360. So if you are apply the logic of 30 divided by 360, then you do not have to calculate the actual days. How many months are there? 5 months. So how many? So 5 into 30 days divided by 360. So it will be equal to 41.667. And actual divided by actual, that is 149 divided by actually in a year there are. So then actual days would in a year would differ only if it is a leap year, right?
Yes.
If it is a leap year, put 366. If it is a normal year, you put 360, right? And you calculate this actual divided by actual. Okay? Whichever method you choose. For example, you have to use one method consistently. Every market and every investor has a choice. So whatever that market is providing the choice with, so this is how your dirty price will be calculated. If the convention is 30 by 360, your dirty price will be equal to 970 plus 41.6667, right? If your convention is actual days by 360, then your market price will be your dirty price at which the trade will happen will be equal to what? Market price plus accrued interest of 41.3889 calculated based on actual days by 360.
Okay.
Right? Okay. Any confusion on this?
No.
Anyone?
Yeah, Sumit.
Yeah, go ahead.
Sumit, that accrued interest thing, I lost in between.
Mr. Raj, accrued interest is nothing but for how many months you held the securities. See, because you are selling the security on 30th May, company will not come and pay you interest for 30th May. That means, hey, Srikar, hey, Shashank, you hold the securities for 5 months. We will reward you for 5 months of interest. Why? Because company follow a simple mechanism. Interest will be paid semi-annually. That means after 6 months, whosoever will be holding the security will receive 50 rupees. Yes or no?
Yes, got it.
Right? Now, but Shashank, if you had bought it and you hold it for till 30th May, obviously you will not sell it for a price which is 970. You will say, boss, 970 to iska market price hai. I agree. But I have held the securities for 5 months. So I am entitled to receive for 5 months of interest. Now, company is not paying me, but company is going to pay you as a buyer. You are the new buyer of the security. So you will be the owner of the security now. So company will pay you, but the company will not pay you for 1 month. Company will pay you for the entire 6 months. But you would be holding the security at the time of payment of this only for 1 month. So you are entitled to receive only 1 month of interest. The remaining 5 months of interest will come to me. So the sell value will not be 970. It will be 970 plus that 5 months of accrued interest. Is it clear now?
Yes, now got it. Yes.
Yeah.
Yes.
That is the concept of dirty price.
Okay.
Any confusion, guys? Anyone more? Any confusion?
No, Sumit.
Okay. So moving forward, guys, one of the biggest risk in fixed income security is the issuer defaults. That means at the time of getting money, it takes money from you, but at the time of redeeming or redemption, it doesn't pay you money back. So that is the biggest risk in fixed income securities, right? So do not think that any issuer with a very high credit rating, if he's issuing, that doesn't mean their default risk is not there. Even a company with a very high risk can default on its debt. In recent history, IIFL, having a very high rating, has defaulted on the securities. So even a very high credit rating company can also default on its securities, right? You understand that? Yes or no? Do you understand that? Tell me. So, yeah. So it doesn't matter, guys. Credit rating is important, but that doesn't mean, Aditya, that because credit rating is very high, you go blinded. Are you getting what I'm saying? Keeping that there is no risk at all. Even a high credit rating company can default on securities, right?
Yes.
Okay. Now let's understand the process of securitization, guys. And that's the last topic in this securitization. Now, before coming to securitization, let me take your intro because this can be slightly longer concept and we might not be able to complete it all in today. Well, I'll try to do it, but I'll not run. As you guys know, I do not run like that. So just before that, let me take your, I do the same mistake all the time. I've never kept your link as bookmark. So let me check the link of last Sunday. Last Sunday we had a session.
Sumit?
Yeah.
Just a curiosity to ask, the buyer of the new buyer of the bond will on 30th of June, he will get 1050, like 50 rupees upper as a interest, right?
50, he'll receive only 50 rupees, boss. Why would he receive 1050? He will
No,
receive
no, just
1000 as the
50
redemption
rupees,
value.
yeah.
So
Not the
50
redemption
rupees
value,
coupon
just
payment,
50
na?
rupees. Yeah.
50 rupees of coupon payment, तो उसको मिलेगा ही ना, boss. He's the holder of the security, so he's entitled to receive coupon from the company, right? That's a separate relationship between the, as compared to what is the market relationship between the buyers and sellers. The relationship between company and the holder of the security is same. Company will keep paying the holder of the security coupon.
Okay.
Company has taken a loan, so company has to pay interest, right?
Yeah, yeah.
The only thing is that this loan is tradable loan. So the owner of this loan keeps on changing. That's the only reason. Please go ahead with your curiosity. What else?
No, it just got mixed with
satisfied nahi lag rahe ho. You're not sounding very satisfied. So why not you ask further question on it?
नहीं, actually कैसा होगा कि मैं दो चीज में मिक्स हो गया मेरा क्यूरियोसिटी. तो मैंने लाइक रिडम्पशन वैल्यू और वो कूपन वैल्यू भी एक साथ ये कर दिया, तो उस वजह से थोड़ा क्यूरियोसिटी वैसे हो गया, बट
अभी समझ में आ
लेटर
गया?
दैट इट गॉट क्लियर.
It got clear? ठीक है.
Yeah.
हाँ चलो, let's take the tendency. सत्या की
Yeah, present, sir.
boss, why you are present all the session? Why not you take off and remain absent? Huh? What is the motivation? Tell me.
Nothing, sir. Actually, today I was just busy with my office work. Just came today
वो तो
on.
ठीक है, but why are you present in all the session? My question is, why don't you remain absent in some of the session? Tell me.
No, no.
What is so interesting?
It's mandatory to be present, sir.
So much because it is mandatory, that is why you come. I thought I am sounding it so interesting, that is why you come. So my
No,
bad.
no, that is.
Huh. You understand that, right? So this is not my okay. I thought I teach very interesting.
Nothing like that, sir. Nothing like that.
नहीं चलेगा, कोई नहीं.
Sumit? Yeah, even I'm not able to hear. I think Sumit's connection is lost. Yeah, Aditya, even I can't hear. Can you hear me?
Yes, I can hear you.
Okay, okay.
All right. So sorry for this sudden drop in my network, and really sorry for this. Guys, are you still there with me, right? On it?
Yes.
Yes.
Well, sorry for this
Yes.
disruption, guys. Really sorry for this.
It's
So we will
okay.
take.
It's okay.
Yeah, thank you for understanding, guys. So all of a sudden it dropped. Yes. Okay. So Sweta, Karta Kareem, Priyanka,
Yes, Sumit.
Praveen Kumar,
Yeah, Sumit.
Kamesh.
He has network issue. He texted me.
Okay, it's great. Santosh is there. I'm sure Santosh is there. Shravani Chula, Shravani is there. She had asked. Aditya Podar is there. Yes. There.
Number
Shashank
6,
Raj
sir.
is there.
Number 6.
Anand Kishore. Sorry, somebody saying something.
Panduranga.
Ramesh, I have marked it present. It's fine, understood.
Okay.
Anand Kishore. Okay, Richa.
Yes, Sumit.
Yeah, there. Okay. Sujata. Ratnesh. Monica.
Yes, Sumit.
Yash Ajay Pratap Singh. Okay. Ayushi Singh is there. Okay. Subhalakshmi.
Yes, Sumit.
Prasad is there. Okay. Is there. Dixit.
Yes, I am there.
Yeah. Rakshanda. Rakshanda. Pratik.
She's there having network.
Okay.
Yes, Sumit.
Pratik is there. Yeah. Mark you present, Rakshanda. Chandar. Chandar Shekhar. Okay. Dhruv. Samvit Gupta. Dhruv is there. Mayank is there. Chandan is there. Surabhi is there. Shruti. Tanga Shruti, yes.
Hi, Sumit. Hi,
Yeah.
Sumit.
Hi. Yeah. Okay, you're there, right? Yes. Great. You did speak today, so I guess you are in your workplace, maybe. That's why.
No, I'm having network issues, Sumit.
Okay. Okay. I also had you just saw. It just dropped all of a sudden, and I didn't. Okay. Yeah, I understand. So Nehal is there. Nehal is always there. Kiran brother.
Yes, Sumit, I'm there.
Okay. Sai Girithar V. Okay. Rahul Pathak.
Yes, sir.
Hepzibah.
Yes, Sumit, I'm there.
Ramesh Kumar.
Yes.
Mega
Yes, Sumit.
Harshita. Great.
Yes, Sumit.
Harshita.
Yes,
Yeah.
Sumit.
Abhinav. Yeah. Abhinav. Okay. Saurabh.
Yes, sir.
Shrey.
Yes, sir.
Shanaz is there. Yash Kenya.
Yes, Sumit.
Vijay Kumar Raju. Ritik Kumar. Ankit Sarkar. Shubham Khurana is there. Smriti. Mayank Sharma.
Yes, Sumit.
Samir Chandrakar. Ritvika.
Yes.
Priyanka Khamkar. Nivedita.
Yes, Sumit. Present.
Nabanita. Amrit Gupta. Okay. So let's go to our concept of securitization. Yeah. Okay. So, okay, everything got closed, so I'll have to open it again. Yeah. So we were at the concept of securitization, guys, and let's do it. Securitization, where is that? Yeah. So securitization, guys, securities, right? What is securities? Securities is something which makes it easier for you to buy and sell, right? So, Louis, if I want you to buy a house of 10 crore rupees, it is difficult, right?
That is right.
And real estate investment is always difficult like this, right?
Yes.
But if I ask you to buy a company, it is not that difficult. Why? For example, your own company, it would not be that difficult. If I want you to become an owner of a real estate as compared to an owner of securities of your company, which is easier?
Both are not easy.
अच्छा, emphasis छोड़ दीजिए, मतलब for example buy securities of some other company, maybe emphasis का आपको कोई trading window होगा, because of that might be tough for you. But as such, why it's tough? Because you can gain the ownership by just buying some shares of the company, right?
That is right. But you got to have that kind of liquid cash assets.
For example, even if, for example, you have 1 lakh rupees, you can get ownership. So to get ownership of a company, you do not have to become 100% owner of it and buy all the shares which are there in the market. But to become an owner of a land, you have to have that much of cash to become, because nobody is going to sell their land in parcels. For example, a 1500 square feet of land itself is a very small land. And you say, no, I have money to pay only 3 square feet of land. Do you think anybody is going to sell you? No. But if you say, I want to buy only 0.0303% ownership of your company, emphasis, would you find the seller for those shares? Yes, you will find in the stock market, right?
Yes.
So basically, I know, well, you got the concept. What I'm trying to say is securitization makes it easier to invest, right? If, for example, the real estate property, which is, for example, 10 crore rupees, which you are not maybe able to buy right away. But if I say, I am ready to convert that 10 crore rupees into 10,000 shares. I'm ready to convert that property of 10 crore rupees into how many shares? 10,000 shares. Now, if you want to buy only 1 share, it would be cost how much? 10,000 rupees. Can you become owner of that company?
Yes.
Can you take a part ownership into that real estate? The real
Yes.
estate which you could have never thought of buying, suddenly you can have part ownership. Obviously, you will not, again, by investing 10,000, you can't claim that I am 100% owner of that asset. But still, you have certain percentage of ownership. What is that percentage of ownership you have? You have ownership worth of 10,000 rupees for something which is worth 10 crore rupees. So you have ownership of how much percentage? 0.1%.
Right.
Right. So securitization makes it easier, 0.01%. Securitization makes it easier to take part ownership into something which otherwise a very illiquid kind of asset, right? Or which is otherwise a very far-fetched asset for normal investors like you and me, right? So securitization is a concept, guys, where you can raise capital through investors, a large sum of capital through investors by selling the ownership in pieces. Anything which is very expensive, create a security out of it, direct it into securities of multiple ownership, and then start selling those securities. Suddenly, something which was completely illiquid will become liquid, right? Any confusion with respect to the process of securities?
No.
No, right?
No, sir.
Yeah. So how the securitization as a concept is cherished by banking? You know, what is the asset for bank? What is the asset for bank? What is the asset for bank? Near, why not you try? What is the asset for a bank?
How many loans they have given out?
The loans which they have given out, right? And a bank can give out what kind of loans? Tell me, if you can differentiate. What are the varieties of loans they can
Home loan, personal loan,
home loan,
vehicle loan.
personal loan, vehicle loan, and
The education loan.
Education loan. Okay. What else?
Gold loan.
Gold loans. Okay. What else? So agri loans, variety of license, right?
Business
Now,
loan.
business loans, correct. So all these loans are nothing but asset for the bank, right?
Yes.
Why they are asset for anything? See, the only why a Bitcoin cannot be an asset, or why gold or a loan will be an asset, because Bitcoin might not generate regular flow of income, but by definition, asset is something which generates regular flow of income. So all these loans will generate regular flow of income for the bank or not?
Yes.
Right? It will generate regular flow of income in the form of interest, right?
Yes.
So by that definition, we can put a tick on this very important feature of asset. Asset is something which can generate a regular flow of income, can be categorized as asset. So that definition of the asset can be tick marked when you are talking about the loan which are given by bank, right? Because it generates regular flow of income in the form of interest. Now, but it does generate regular flow of income, but that is only a percentage of its total worth. If, for example, if you give a loan worth rupees 1,000, you might generate 1% interest per month. That would be equal to 10 rupees per month, right?
Yes.
So the percentage return which you will get would be very small, value, or regular flow of income which you will get is a very small value. But as such, those assets are highly illiquid assets. Why they are highly illiquid assets? Especially not all kind of bank loans, but the bank loans where tenures offered are very high. For example, home loan. On home loans, what is the tenure offered? Tell me. What is the general tenure offered on home loan by banks?
20 years. 30
Highest
years.
of 30 years.
30 years, 25 years, 30 years. This is the tenure, right? So think about it. These home loans are asset for the bank. They are generating regular income for the bank, but they are highly illiquid because it will take 30 whole years to get your money back. Yes or no?
Yes.
Can we say these are illiquid assets?
Yes.
Right? And on these illiquid assets on which you are going to get your money back in 30 years, if you apply the concept of securitization, can you immediately get your money back by selling these loans in the form of securities? That means, for example, you have a portfolio of 1,000 crore rupees of home loan. Portfolio of how much? 1,000 crore rupees of home loan. That 1,000 crore rupees will come to you over a period of 30 years. For example, the duration of those loans is 30 years. Or let's keep it 20 years. Not all loans are for 30 years, right? Some loans are for 10 years, some loans are for the period of 20 years, and some for a loan of 30 years, right? So let's assume 20 years is the average duration of that loan book, right? Now, something which is going to come to you in 20 years period of time, if you apply a concept of security, that means all those loans of 1,000 crore rupees, if you want to sell to one person, might be you will not find many investors, right? Because 1,000 crore rupees as such is very big amount, right?
Yes.
If you convert it to securities of 10 rupees each, so how many shares you would have to issue? 100 crore shares. How many shares?
100 crore.
If you issue 100 crore shares to investors, and first it would increase the liquidity because selling 1,000 crore rupees of loan to one investor and selling one share of 10 rupees each, right, to 100 crore people, which is easy. Obviously, it is not 100 crore people. You are issuing a security of 10 rupees, but there would be ready to invest. Somebody who's ready to invest 1 lakh rupees, somebody who's ready to invest 10,000 rupees. So accordingly, the number of shares will be given to him, right? So which one is easier, selling 1,000 rupees to one person, or 1,000 crore rupees worth something to
multiple
more than
parties.
one people by multiple parties by putting it into different securities, which is easy?
The later one is easy.
The later one. Why? Because the investment per person then goes down. So a lot of people who as such can't see that as an investment opportunity can start seeing that as an investment opportunity, right? Right? Because, for example, a house of 100 crore rupees can be an investment opportunity for Mukesh Ambani, but it can't be an investment opportunity for you and me, right?
Yes.
So, but suddenly if that house gets parked into securities of 10 rupees each, and if you want to invest only 1 lakh rupees, so you can get 1 lakh divided by 100 crore type of ownership of that lend, right? Right? Your investment will be 1 lakh divided by 100 value, 100 crore total value of the asset. That would be your ownership stake in that, right? So suddenly, so it's proven that it's easy, it improves the liquidity. So you are converting those into securities and selling it to varied investors. What is the benefit for the bank? The bank, which is going to get something over a period of 20 years, will suddenly get the entire money immediately. And how will it help? It will help bank because bank's business is to give loan, right? So it can generate more loans now. Yes or no? It can expand its business further aggressively, right? Otherwise, it would have waited for 20 years, which would have come in pieces, and then it would have expanded its business because it would have used that money to give more loans, right? Now, all of a sudden, it is sitting on a cash of 1,000 crores, so it can expand its business in multiple geographies or multiple product lines. Yes or no?
Yes.
So that is the concept of securitization. And the concept of securitization can be, and these kind of securities can be two types which bank issued. One is mortgage-backed securities and second is asset-backed securities. So when the home loans or anything which is real estate oriented, so banks can do loan against property, that is LAP. Bank can do home loan or any loan where bank is giving loan against a property, be it commercial property or it is residential property. If real estate is involved, it is called as mortgage-backed. It's called as what?
Mortgage.
What
was the letter word? Sorry, Sumit. Mortgage and
mortgage-backed securities. The securities which are
backed by mortgage.
For no, don't say securities backed by mortgages. That's not. Please don't say. The definition is the securities which are issued on those loans which are backed by real estate mortgages. See, securities are backed by mortgages indirectly, but directly loans are backed by securities, right? Sorry, on these mortgages. And you are issuing securities on those loans, not on those securities, because bank as such doesn't have the ownership of those real estate properties, right? Bank is the owner of the loan, right? For bank, asset is not real estate property. For bank, asset is loan. So bank is issuing securities on those loans which are backed by real estate as collateral. Real estate as collateral, right? So these are called mortgage-backed securities. And for any other loan other than real estate loans, for any other loans, if banks issue securities, then it is called as asset-backed. What could those loans be? And anything other than real estate. So, for example, bank can give loan against securities of gold, right? Bank can give loan against securities of vehicle as vehicle finance because bank gives vehicle as securities. Bank can give loan against. Tell me, come on. Can give loan against inventories. For example, if you are taking a working capital loan, what is given as securities to bank? Your stock, your inventory of goods, right? So bank can take security, bank can give loan based on many kinds of securities. All those securities other than real estate, all those collaterals other than real estate collateral would be categorized as loans which are backed by some asset other than real estate. And if you create a securities on those loans, they are called as asset-backed loans. Asset-backed securities. Do you get it? The difference between mortgage-backed securities and asset-backed securities?
Yes.
Yeah. Luis, do you get it? Anyone else?
Yes,
Aditya, do you get it? Yeah, do you get it? Aditya?
Yes, sir.
Yeah. So we'll stop here because I will go into the process of it. Let's stop it over here because process and this entire, if you guys heard, I guess Lewis and all who are dealing with anyways in US market, they are very well aware about the subprime crisis. But as such, I guess most of the people in the session would have heard some subprime crisis of US, right? It is directly linked with mortgage-backed securities. It has very close connection. The whole reason was mortgage-backed securities and excessive greed on earning return on mortgage-backed securities. But we'll talk about that entire concept and we'll touch upon some flavors of subprime crisis tomorrow while we start it, right? Because right now we are only left with 5 minutes. It would, rather than creating any learning, it will actually end up creating confusion, right? So we'll stop over here. It's already 8, right? My laptop watch is not running on time. My laptop is struggling with the problem. But yeah, right now it is already 8, right? We are not even left with 5 minutes. So till here, whatever we discussed, any question on that before we close?
No, Sumit.
Anyone? Come on.
No, sir.
Okay. 2 no's. I want to see at least 10 no's before we part of today. Or yes, if there is confusion, say yes, I'll clear it out. I don't mind staying 15 minutes, 30 minutes more. But just you have to tell me if there is any question. Come on, I still had heard only 3 no's. So come on,
No,
there are
Sumit.
32 people. No, okay, 4 no's. I want to hear at least 10 no's. 5,
No,
6, 7, 8. 2 more.
No, sir.
9. And nobody's repeating. I believe nobody's repeating over here, right? In 9, there is no repetition. Okay,
But
one
I
more.
have a doubt.
Yeah, go ahead. Please go ahead. Come
Hello.
on, tell me what is the doubt. Yeah,
So the
I'm
relation,
listening.
yeah. Sumit, am I audible?
Yes, you are audible. I can hear you. Please go ahead with your question.
Yeah, yeah. So the relationship between yield and market price is inversely
inverse.
proportional.
Correct.
Yeah.
It's inversely proportional. If the yield in the market goes up, the bond prices will go down.
Okay.
Right? We saw some examples like that, right?
Okay. Okay.
Right. Yeah. So it is an inverse proportion. Correct.
Thank you, Sumit. Thank you.
Yeah. Thank you. So 9 no's I heard. 1 yes I heard. So yes is cancelled out. So still I want to hear one more no before we leave. Come on. Any question? One more no and we will leave. Come on, one more no, guys. Come on. Or if there is yes, go ahead with yes. Any question? Mayank? Yes, Kenny, any question?
No, Sumit.
All right. Richa? Richa Singh? Richa is not on her desk, it seems. Rahul? Any question, Patak? Mr. Patak?
No, Sumit, I don't have any question.
Okay. All right, then let's. Yes, Rahul.
Something I don't have any question.
All right, cool.
In a
Then-
market that can't able to hear it properly because there are power in my
It's
house.
fine. It's okay, Rahul. I understand. Okay, chalo, cool. So we'll close off it up to here. We'll continue from here. We'll touch upon the concept of mortgage-backed securities even more from the process point of view. I'll tell you how exactly bank goes and what is the entire process it follows and how investment bank comes into picture here. Till then, just go through the content which is there on your LMS portal. Thank you for your time. I wish you all the best. Let's close off today's session and we'll continue from tomorrow. Yeah, from where we left.
Thank you, Sumit. Thank you,
Thank you.
everyone.
Thank you, Sumit.
Thank you.
Bye.
Thank you. Thank you.
Thank you,
Thank you,
Sumit.
sir.
Thank you.
Thank you. Thank you, Rahul. Bye. Thank you, Kiran.
Thank you, Sumit.
Thank you. Thanks, Harshi.
Thank you.
Thanks, Richa. Okay. All right. Thank you, Shubham, Praveen, Kamesh, everyone. Rakshanda. Bye. Bye, Mr. Raj. Bye. Thank you.